you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Caught in such a, between a rock and a hard spot where they've been so hawkish starting at Jackson Hole, they've been continuing that message. But I think someone's got to step back and say, okay, we've got to be a little bit careful. I think Powell, as usual, is going to wind up having to let some of his inner dove come out.
Some of his inner dove. Peter Chitt, head of macro strategy at Academy Securities. What do you make of that, Lisa? Your inner dove.
Inner dove, except it's about protecting the economy from sinking too much and not unleashing the animal spirits of people who are looking for a pivot. It's a very weird dance.
Bramo doesn't like to brag, but in the commercial break, she just wanted the whole control room to know that her Uber rating is 5, and I just thought I'd let you all know as well.
Thank you.
Just wanted everybody to know.
That.
And I have to say, Anne-Marie's in the other studio, and she's very quiet. She hasn't spoken.
She doesn't have her mic on. You can't say that's when she doesn't have her mic on.
She's laughing, but she's still quiet, okay? Reading between the lights if you want to. Futures are down 0.5% on the S&P 500. On the Nasdaq 100, we're down about 0.6%. We are softer, lighter, lower, negative, and yields are higher by 4 basis points. 350, 336 on a 10-year, the 2-year, getting closer and closer to 4% this morning. Here's a quote for you from Amin Nasser of Saudi Aramco. When the global economy recovers, we can expect demand to rebound further, eliminating the little spare oil production capacity out there. Credit to Tom, Lisa, who often brings this up. Can you imagine the commodity situation if China was back online without its COVID-0 policy?
I keep wondering, is this a headwind or a tailwind for the global economy, right? Because on one hand, you then get more activity from China, but on the other hand, you get a dramatic repricing in oil prices, considering that their demand has been falling off a cliff at a record pace, right? I mean, how much does that change the scenario, and how much is that a possibility in the near term?
Alan Wald joins us now, the Senior Fellow at the Atlantic Council, good friend of this program over the years. Alan, let's start there. What would happen if China dropped COVID-0? What would happen to this commodity market?
Yeah, I mean, I think we would just see an explosion in prices because we just don't have enough supply of basically anything at this point, but oil would definitely be the number one. I mean, right now we're kind of basically what we're seeing is that some of the global SPR releases have basically smoothed over the fact that we have a supply deficit right now. So if we see an increase in demand, and in fact, if we do see what they're predicting as 3% global growth, and that's basically with recessions, in Europe at the very least, and possibly in the United States too. If we see that in 2023, we're going to need an extra 1.5 million barrels a day in global oil demand anyway. And there's absolutely no indication that we have that spare capacity anywhere. Investment is just way too low. I mean, I think we're looking at investment is too low just to replace what we need for our current demand, let alone go forward to accommodate a growing demand.
So, Ellen, perhaps this is an unfair question, but you said that the SPR release is papering over the deficits in supply and allowing prices to go down. So if the U.S. were not releasing millions of barrels of oil to the market, where would crude prices be?
I think they'd definitely be higher. It's hard to give an exact number because a lot of that papering over is also a result of, the kind of the paper market as opposed to the physical market. Plus, we keep seeing fears of a recession causing prices to go lower when, in fact, there are indicators that we may not see a recession. There are some pretty positive indicators in terms of industrial production in the United States. Of course, then we have all of these issues in terms of supply chain. We've got these huge price increases like the one you mentioned from Ford. We're seeing that all across the board. So we're really kind of in this place where we're not really sure whether we're going to end up in a recession or not. And it also depends on the increases in the interest rate. That could definitely send us into recession, which might, be a good thing inflation-wise, but could definitely cause oil prices to go down. On the other hand, other countries in the world, developing nations, aren't necessarily heading towards recessions, and they could put pressure on global oil demand too. So we're really in a place where certain things are kind of covering for the fact that we are technically in a supply deficit. And if those things go away, like one of them being the SPR release, we could definitely see higher oil prices. But on the other hand, we could see lower.
Well, thank you. I guess that's an evergreen comment. Going forward, though, putting aside the macroeconomic guessing game of will we or won't we get a recession, if you just look at the on-the-ground fundamentals, does the decline in price make sense?
I think it does make sense to some extent because we saw such high increases due to speculation over the geopolitical situation and some of the other issues that we're now seeing a kind of backing off of that. I mean, I think $120 a barrel was too high for the supply-demand situation, and so we're seeing that back off. Of course, some does depend on what happens in December with the sanctions on Russian oil, and if that actually does take any Russian barrels off the market.
Ellen, do you think we've seen enough of a material rethink about how much more investment CapEx we need in the oil patch, Ellen, and how we go about incentivizing that?
Not at all.
I mean, NASA goes through the numbers,
I don't
the
think
numbers, Ellen, are just
nearly
amazing.
enough of that.
700 billion in 2014,
serious
300 billion in 2021.
Basically everywhere.
Ellen, well, thank you for the Atlantic Council. I don't know why we ended up speaking over each other. You can hear me, I couldn't hear you, but thanks for letting me know. Ellen, thank you. Those numbers, Lisa, are just amazing. 700 billion in 2014, 300 billion in 2021. I mean, NASA just saying, quote, too little, too late.
And it's everywhere. I mean, if you take a look at, for example, in the shale patch, some of the most productive oil patches I was reading in the Wall Street Journal are basically used up. They can't really get as much, so they aren't producing as much, and they're not investing as much, and debt investors haven't been going in because they got burned back in 2014. So you raise a question, and there's a political question behind it, which is this sort of uncomfortable incentivizing of fossil fuel companies at a time when a lot of these governments want to move to greener energies. And how do you do that dance? I mean, how much is that going to be discussion of the UNGA?
Just throwing that in there. This came from Amin Nasser as well, this quote. The conflict in Ukraine has certainly intensified the effects of the energy crisis, but it is not the root cause. He went on to say, sadly, even if the conflict stopped today, as we all wish, the crisis would not end. That's a big, big problem for Europe and beyond.
Well, and right now, we're just getting a headline that Germany is closing in on a deal to nationalize one of their gas companies, Uniper. And this is sort of the solution over in Europe, or Germany in particular, is nationalizing companies. Well, okay, what kind of investment comes with that? What kind of incentivizing comes with that? How do you have a free market at a time when the only solution that you may have is to just take governmental control over it? I mean, this is a difficult situation they're facing into.
I feel terrible for speaking over Ellen. The control room tells me her video froze. If that helps. Technical issues, apparently. Ellen Wald, we'll get it back soon. Futures down 0.4 on the S&P. On the Nasdaq 100, we're down 0.5%. I'm sure that sounded ridiculous to people at home. Yields up 4 basis points on a 10-year, 353.36 on a 10-year, and two-year yields. Two-year yields have been absolutely flying for the last week or so. Gone 20 basis points from last year, 12 months ago, from 20 basis points to 353 on a 10-year to 396 on a 2-year. Just 20 basis points 12 months ago, and now approaching 4% at the front end of the curve. Anna Han of Wells Fargo joins us shortly from New York. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
We're definitely seeing resilience in the U.S. economy. The labor market's still strong.
I think Powell, as usual, is going to wind up having to let some of his inner Doug come out.
Fed policy is showing up in full force already.
Trying to sort of engineer the soft landing, I think, is a very delicate dance.
I think we've probably not seen the worst of it yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Yields absolutely flying over the last couple of weeks. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back in the building tomorrow for Fed Decision Day. Futures down 0.4% on the S&P. On the Nasdaq, Lisa, down 0.5%. And we've said it repeatedly in the last hour. The poison is in the bond market.
It has been a complete reset, and it comes as you have more than a dozen central banks having decisions, and all consecutively raising rates, with the exception of one, the Bank of Japan. But other than that, everyone is basically talking about regime change, where they're fighting inflation, and that is the foremost concern, and you're seeing that borne out through markets.
What gets your attention more so? Is it the level or the speed, the rate of change we've seen in this bond market over the last few weeks?
It's both, right? But the speed is really shocking because you're having a complete reset and a sudden thought of 4% two-year yields, which would be the highest levels going back to 2007. It already is there. But the speed, 3 percentage point increase. How much work has the bond market, this is sort of your phrasing, right? How much work has the bond market done for the Fed? It seems like the Fed doesn't think enough, which is the reason why some people are saying 100 basis points could still be on the table during the meeting.
And that's the nominal yield. We need to talk about real yields as well on a 10-year, all the way back, Lisa, all the way back to 2011.
Although Chris Verone said we still don't have positive real yields. I mean, this is basically a fiction because this is gaming out what the inflation rate would be when you start talking about a 9% CPI rate or an 8% CPI rate. Getting 4% or 3.5% on 10-year doesn't look that great. So the question really is, how much more do you see that increase if people start to think inflation maybe will stay high for longer?
The two camps are amazing right now. We both get the pushback. I get the pushback from people who say 4% isn't enough. You've got to go higher than that, maybe the Deutsche Bank's world of close to 5%. Then there's another camp who say, no, it's too much. The economy can't operate with a 4% Fed funds rate. Just polar opposite views right now.
And how much is it really decided by where you are? How much are people outside of the U.S. saying 4% is too much? Because you're seeing the dollar strengthen and you're seeing the World Bank start to warn about this. And then in the U.S., people are saying it's not about the rest of the world. It's about the United States. We just don't know. It's just the original moment of economic history that is very hard to really create a roadmap for.
Fed decision just around the corner, live from New York City this morning. Good morning. Let's whip through the price action. We're lower by 1/3% on the S&P. On the Nasdaq 100, down by 0.4%. Yields are higher by 4 or 5 basis points. 350, 356 on a 10-year. The highs of the year. The 2-year, 396 and pushing 4%. Crude lower by 0.4%, 85.39 on WTI, and as I said repeatedly over the last couple of days, just about holding on to parity, Lisa, here on euro dollar, -0.2%.
When we talk about some of the rate decisions that we're coming up against, one of the big questions is how quickly is rate policy transmitted into the economy, and the real place to look for that is the housing market. At 8:30 a.m., we get August housing starts and building permits for the United States. This comes after yesterday. We got home builder sentiment declining for yet another month, the longest streak of declines for home builder sentiment going back to the mid-1980s. It just shows the pace of the decline, at least in this one area. Again, I go to this question of the transmission mechanism because a lot of people don't have debt. Consumer debts are actually lower than they have been traditionally. Corporations have plenty of cash, which raises a question of what it will do if the Fed does raise rates, all the more so in order to combat inflation. Today is the beginning of a 2-day FOMC meeting. We will get that rate decision, and it comes as that 2-year yield, which we've been talking about, continues to climb. 4%, does that get it done? 4.25%, 4.5%. What do they say? How do they push back against the moves that we've seen, the pace of them and the levels? And today, President Biden is going to clog up traffic in New York City. He's attending the Democratic National Committee reception tonight. Tomorrow, he goes to, should I do it? UNGA,
sure,
United Nations General Assembly. I wouldn't even say that. If you hadn't said that, I wouldn't have even thought to say that. I mean, UNGA...
It doesn't bother me that much that I'm going to get annoyed about it. I just prefer that we just said the UN General Assembly.
Well, he's going to attend, and I want to understand where the camps are in terms of allies and also the policy with respect to China. Because honestly, his rhetoric has gotten so harsh recently with respect to Taiwan. It's taken a very different stance than some of the prior presidents. How does this translate into a more different or just a changed approach toward China?
Anne-Marie says UNGA all the time. all the time. She'll be back
walks around
listen,
the
10
studio.
minutes. Just
Unga.
walks around saying it, just repeatedly. When she's in New York.
She's just in the other room, like, why are you guys doing this
What are you
to me?
talking about?
Exactly.
Lisa, thank you. The president meeting with Liz Truss tomorrow. We'll hear from him, as Lisa pointed out. Von der Leyen as well, meeting with the Prime Minister Liz Truss in New York tomorrow too. So Liz Truss is going to be pretty busy, the British Prime Minister, and she's got to hit the ground running in a big, big way. They've got a budget later this week, a mini budget, I'm told, and a Bank of England rate decision as well. We'll save that for later in the week. We need to get to this equity market. We can discuss it with Anna Han, the equity strategist at Wells Fargo Securities. Anna, wonderful to catch up with you as always. You've got to give us one reason to be bullish here, because everything is so gloomy.
Well, this isn't going to be the best answer here, John, but some reason is to say things might not be as bad as feared. One of the biggest things we're watching is conference season. We want to tone on how corporate earnings and outlooks are going, but, you know, from the early reporters so far, it was not so great. I think we're hoping to see that at least margins and growth can peter out for the rest of this year and be somewhat of not the worst news. That could be one of the things. But on top of that, I think the bigger risk and tail risk aspects are going to be really European energy crisis and how midterm elections go this year.
We were talking with Chris Verone about a lost decade. How many people you speak to really have thought through the concept of a lost decade of profits, of gains for U.S. stocks?
You know, that's a great point. It's hard to see the impact, what we thought was one of the shortest recessions, and yet now we're battling some of the highest inflation. How long that could possibly persist? How much of earnings was robbed from us in that time? But, you know, what's been really the engine here has been the strength of the labor market, the strength of the consumer, and how long that stays resilient in the face of persisting inflation. That's going to tell us how much we can really recover or gain back from that lost earnings that we've had.
But that said, Anna, when you start talking about real yield, when you start talking about a nearly 4% two-year yield, when you start talking about going into full faith and credit and actually earning income, it presents a comparable or competitive story to equities for the first time in decades. How much does that change the equation and raise the bar, even if the consumer still does have money to spend?
No, that's a great point, Lisa, because when you look at earnings yield on the S&P 500, or you look at who actually has even a higher dividend yield in their dividends paid for corporates versus what you can get in the fixed income markets, it begs the question, how much of your portfolio do you want to allocate to U.S. equities versus some more of that steady Eddie dividend pair, that coupon clipper style? And that's really weighing on people's minds, which is why corporate earnings is so important. And as real yields rise and mortgage rates are higher and starts eating into people's pockets, that's what they're thinking about.
And one thing that you and Chris have said over the last week with regards to the Fed is the decelerating path to a terminal rate can be a positive for stocks. And what kind of pushback did you get from clients when you told them that?
I think the biggest pushback actually was in the reverse. The first was the market was pricing in cuts rather sooner than we were looking at. And that was something that had to kind of come out of the market and flush out of the equity market. But now that we're thinking that things could slow down, of course, the number one argument is going to be, well, inflation is going to persist. It's going to continue ratcheting higher. And perhaps what we thought the biggest components that might come down, for example, the OER rate or owner's equivalent rent, maybe that component doesn't come down as quickly. That's what's worrying people. If that does not come down, if we continue to see high 8 handles on these CPI prints, then really, can the Fed, do they have a choice, or would they have to remain hawkish, maybe continue on their 75 basis point path? For us, we think that that's unlikely so far. Our house view is that terminal rate for this year is closer to 4, but a bit quite shy from getting to 5 for the end of 2023. But that is the argument out there, and that's something we're thinking about.
Next question is your fault. This is from Market Watch. New ETFs with tickers Nance and Cruz aim to track lawmakers' stock buys as ban on congressional trading looks unlikely before midterm elections. Of course, they're referring there to Speaker Pelosi and Senator Cruz. Anna, this got your attention. You made sure it got mine. What'd you make of this?
I think it brings into focus midterm elections. There are a lot of hot topics that we're going to be discussing, and it's going to be quite polarizing. Not only are we talking about congressional trading, but now we have President Biden in New York, one of the hot topics being Taiwan and China. There are a lot of things going around in this midterm election that very much could bring uncertainty to the equity markets. And right now, you've seen the massive shift in polls. First, we thought that the Democrats had a pretty strong hold in keeping the Senate majority, but that has declined. And now, so the change there between who the potential ruling party will be, that can be very volatile for the equity markets. But our view in general is that it's underappreciated how much the GOP has a chance of flipping the House and Senate. And these are things we're watching for come this fall.
Anna Han, thank you, of Wells Fargo. The brilliant Anna Han. Always good to catch up. And thank you for making sure this got my attention. The Nance Fund would be based on Democratic lawmakers' portfolios, Lisa, while Cruz Fund would have stocks held by Republican politicians. To admit, I'd find the makeup of those funds more interesting than 13F filings.
I would agree.
To be honest with you.
I mean, it brings into focus, if you can't beat them, join them, because basically this is looking unlikely that they're going to ban trading of stocks by some of these Congress members ahead of the midterm elections. So join in, see what they know,
All
and
that
basically
criticism of the Federal Reserve, Bram, I would
ride that
they're still not fixing it.
I mean, and this is the amazing thing about Wall Street is Wall Street says, okay, if you're not going to fix it, I'm not going to weigh in morally what you should do, but I'll join you. You know, let's see what you know, and I can just track your stock holdings, and maybe we'll win together.
And do you weight the portfolio
more to
Nance,
Democrat
more
versus
to Cruz? Can you park your politics? Are you able to do
or
that?
do you lean in and see who
you
actually...
lean into your politics, or do you hedge your politics? You should hedge your politics.
We should track which is doing better at different times. Who's picking better stocks? This would be a great index.
Great fun.
Yeah.
Depending on who runs what committee. You know how it works. I'm not saying it does work like that. I'm just saying you know how it might work.
What Uber rating would the ETF have?
That's true. Interesting. Anne-Marie's going to be back with us next to tell her what her Uber rating is.
Oh, I'm sure she will.
We're down 1/3 of 1% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers today begin a two-day meeting that's expected to end with another jumbo interest rate hike. According to economists surveyed by Bloomberg, the Fed will hike its benchmark interest rate by 0.75 of a percentage point for the third straight time. Chair Jerome Powell has made it clear the Fed is committed to curbing inflation sooner rather than later. In Japan, inflation has accelerated to the fastest pace in more than 3 decades, and that creates headaches for the Bank of Japan. It will try to explain why it needs to continue with monetary stimulus when inflation is above its 2% goal. Consumer prices, excluding fresh food, rose 2.8% in August from a year ago. Britain's new Prime Minister, Liz Truss, says that a trade deal between the UK and the US is unlikely in the short to medium term. She says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. Bloomberg's learned that Germany is closing in on a deal to nationalize gas giant Uniper. Now, contracts haven't been signed, but Berlin is aiming for an announcement this week. Germany has been working on a historic takeover of 3 large gas importers to prevent a collapse of its energy market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed Decides. Wednesday on Bloomberg, your global business authority.
The world has a long to-do list. We need finance and investment from the public and private sectors. This is the only sustainable pathway to address the obscene inequalities that exist in every country while ensuring that the world doesn't slide into a recession. Governments need to invest like never before.
Antonio Gutierrez there, the United Nations Secretary General, live from New York City. Good morning. With Lisa Brammertz, I'm Jonathan Ferro. TK back with us tomorrow for decision day for the Federal Reserve. Going into that, futures down on the S&P and on the NASDAQ. We're down about 1/3 of 1%. No real drama here in the equity market, but I would say some drama in the bond market. Yields up by 5 basis points on a 10-year. Your nominal yield, 353.95. Your real yield, the highest since 2011 at the front end of the curve. It's almost like count down for 4% or count up to 4% on a 2-year at the moment. Lisa, 397 on a 2-year, up another 3 basis points.
I think you could categorize this as poison for risk assets.
I agree with you.
I think so.
Okay.
Just personally.
A wise man once said.
A wise man once said poison for the risk assets, and I would agree with him. I think that it's a wise point to raise, especially as the pace of increase just keeps going. I mean, it's just
9
kind of
sessions.
amazing. Yeah.
It's 9 sessions, and we keep on climbing. And Evercore, out with the latest research, I'll share this quote with you, Lisa. It's all about, for them, the dot plot and the summary of economic projections. And they're essentially pointing out that they think the median will be at 4 to 4.25 at the end of 22, peaking at 4.25 to 450, with a sizable number for 450 to 475 in 23, with no cuts next year. That's the way they can push back against some of that rate cut talk, I guess.
Do you like the dot plot? I hate it. I think it's awful.
Hates it.
It's just, it's ridiculous. It's just basically putting something out there, and the facts change, and then they decide to rejigger their estimates. I mean, what is this? We used to have dot plot cupcakes in the newsroom on dot plot days.
We didn't have that in TV. Is that what they had over on the print side?
On the print side, yeah.
Dot cup. Okay, nice.
Anytime.
Look, it had its time, didn't it? When you wanted to communicate very dovish policy for longer, and you wanted to flatten the curve all the way out several years, the dot plot was useful for that.
If they're saying forward guidance is dead, and then they're putting out forward guidance,
then it's no longer useful. I'm with you.
I'm sorry. I'm done with my rant.
We're on the same page. Have a rant about this. I want to go back to this story. New ETFs with tickers Nance and Cruz aim to track lawmakers' stock buys as ban on congressional trading looks unlikely before midterm elections. I don't know how I missed this yesterday. This was from Market Watch. Thank you to Anna Han of Wells Fargo for pointing it out. Anne-Marie's back with us. Up from DC into New York City. AMH, what is this about, and why have they still not addressed the congressional trading issues?
Well, it won't be addressed, as you just said, before the midterm elections, according to Senator Jeff Markey. What we should discuss, though, and part of this is this analysis last week by the New York Times. I'll read some of it to you. At least 97 current members of Congress or their families bought or sold stocks, bonds, or other financial assets that overlapped with their work. Well, I'm going to be fair and give you two of the examples. So, fair and balanced, not partisan here. Senator Tommy Tuberville, Republican of Alabama. He's on the Agricultural Committee. He even admits he's discussing cattle prices, but also he's invested in cattle prices. And then you have Representative Alan Lowenthal, Democrat of California. The New York Times calls it especially striking. His disclosure statement said that he had sold Boeing shares on March 5th, 2020, one day before a House committee on which he sits released damaging findings on the company's handling of its 737 MAX jet, which was obviously involved in 2 fatal crashes. So this is getting now a lot of publicity, of course, but the issue is you have 97 members of Congress who are involved in this. What is the likelihood they're really going to move on this legislation?
Okay, well, what about the pushback from voters? I mean, how much anger is there that they're getting an edge, and now we can track the edge with ETFs that you can also invest in? I mean, to me, the fact that you could even create something where you could potentially join them in their wisdom or knowledge of what's going to happen, how much public pushback is there?
Well, at the moment, there really isn't a lot of public pushback. What you see tracking in polls and what people want to go vote on are things like the economy, the border. That's really 2 big Republican talking points. And then for Democrats, it's the like of what is happening right now with the former president and his issues after the Mar-a-Lago raid, and they were getting all of these national security documents, abortion. These are the issues that obviously are tracking within the public. But I think many Americans probably feel the same way you two do, which is, how would our viewers feel if I was able to trade oil contracts, given the fact that I talk to a lot of people in the oil industry? We would never be allowed to do it. And so I think a big question is, why are elected officials who have sensitive information?
Right, and how much is there transparency around what their holdings are when they trade? How quickly do we learn those positions?
You learn about them later in these disclosures. It's not in real time.
It's right, so it's a lag time. So they've got time to even get out of it before you actually
get ahead of the bad news.
Yeah, okay.
And at that point, it's a news story.
And there's not a lot of pushback. John, what do you think about this? You've stayed
I think
pretty
you
quiet.
know what I think about this.
I think
it's
you
also
wanted
the
to
issue
wind
around
yourself
spouses
up.
as well. I think it's a massive, massive problem for policymakers who we expected to do more when it came to institutions like the Federal Reserve. But at the same time as they were preaching what the Fed should and shouldn't do, they were doing what they're doing, and I think we're all uncomfortable with it, Lisa, and most journalists would tell you, and I think Anne-Marie did a great job of it just there. The rules for journalists are stronger than the rules for the people setting policy, which is amazing.
Yeah, and
just absolutely amazing.
It is amazing, and Anne-Marie, as we head into the midterm elections, you said this really isn't registering. What's the latest view? We've heard some people, including Anna Han, who is just saying that she thinks that people are underplaying the chance the Republicans really make inroads in the House. Is that what you're hearing in terms of the polling, even as the Democrats do gain?
Well, they need 6 seats, right? And they're boosting up on these advertisement campaigns with big money into making sure they can flip the House. The Senate is the one where there's more of a question mark, right? And you had Senator Mitch McConnell come out and say it's really about the caliber of the candidate. Potentially some of these a little bit more fringe individuals that was really backed by the former president and some of his acolytes getting pushed into this big general election. But when you look at a Senate race over a House race, this is a wide variety of people. So there's potential that we're going to have this lame duck Congress, obviously, because it'll be split. And then, of course, the White House will be Democratic. So really a lot of legislation won't be able to get done except for big ticket items. Obviously, they need to get a stopgap funding measure before the midterms, but then after that, things like foreign policy where everyone can line up on, whether it comes to Taiwan, whether it comes to money to Ukraine. That's really the only place you're going to see individuals really cross the aisle.
Anne-Marie, thank you. Love having you in New York City. Stay around. I know she's going to be with us all week.
Taking the subway.
AMH, taking the subway because her Uber rating's so low.
Oh, come on.
It's true.
It's not that low.
It's true.
It's not that low.
It's true.
It's not that low.
How do you know? You haven't seen it.
But I trust Anne-Marie.
I've seen it.
You've seen it.
I've seen it. When we were in London together, we used to tell her how to behave when she gets out of the car. I used to say, don't slam the door.
She's starting to rage in the other room.
One of those people that gets in the Uber and it's like, we got Bluetooth and then wants to like blast music through the speaker.
Okay,
it's really rude.
That's just not who this is.
I've lived it. It's really rude. I'm telling you.
She's over there shaking her fist at you. How could you?
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Live from New York City this morning. Good morning. Can we squeeze out another day of gains on the S&P 500? Right now, just a little bit softer, light to lower negative, 1/3% on the S&P, and still about 6 percentage points higher than the June lows. Your 2-year is 50 basis points higher than the June highs. Right now, up another 2 or 3 basis points. We're climbing now for a 9th straight session on a 2-year yield. It's relentless. We're closing in on 4% at 396. On a 10-year, we're looking at highs we haven't seen since 2007 on a nominal yield. On a real yield, you've got to go all the way back to 2011. And as Lisa and I have said repeatedly through this morning, what's happening in the bond market is absolute poison for what's been developing in stocks. Can you get bullish if we're at 4% on a 2-year yield? In the bond market, you've got to think about the change as well, not just the levels. And to capture that story, just wanted to take a sneak peek at a chart of a 2-year over the last 3, 4, 5 years. Just the valley through the pandemic and then up the other side, almost going vertical over the last several months. 12 months ago, we were at 20 basis points, something like 21, 22 basis points 12 months ago, September 20th, 2021. And right now, Lisa, closing in on 4% at 396.22.
And are we here yet, right? I mean, I guess that's really the question. Is this where we stop or do we keep going? And I guess that's why people care about the dot plot. I don't know that that will really give people more of a sense. But, you know, when do we have a sense of how close we are to finishing this incredible meteoric rise?
And you've raised a good point. It's not just about whether we finish the rise, or it's about whether we stay there for an extended period of time, and we have to push out that view several years. And will these summary of economic projections, which include that so-called dot plot, will they capture, communicate, convey that part of the story?
I mean, honestly, this is the big question. I'm watching this, and I keep also wondering, do we understand the ramifications? And you've been asking this question all day, of the end of an era. Do we understand those ramifications on the economy at a time when we haven't seen yields like this going back more than a decade?
I don't think we have. We're blowing up 10 years of unprecedented monetary policy. Zero interest rates, QE forever, negative yielding debt. Think about it. When we look back at this period, negative yielding debt, not just sovereigns, but also corporates as well. And we're moving away from that. And this idea, and Chris Strategas was great on this about an hour ago on this program. Lisa, this idea that you walk away from that, blow it up, 10 years worth of unprecedented monetary policy, and it resolves itself in a couple of quarters, it's difficult to believe.
Which is the reason why he was talking about a lost decade. And what does that mean in terms of the appeal of cash-like instruments? If you're getting yield there and you're not necessarily getting reliable returns within stocks, do you go back to a stock picker kind of argument, or do you just basically say it's okay to hold out in something more liquid?
Show me some earnings. I think it's got to be the story here. Have we had the rate shock? We can debate that. Are we about to see the earnings scare? Started with FedEx last week, and we're seeing more of it this week too.
Well, that's why I'm watching Ford. And today I've been really looking at what happened there, because they came out and said they're going to take $1 billion hit as a result of the inflation that they're seeing and the slowdown there. And they're seeing that the share prices go down by 4.4% as people try to game out what this means going forward. It's following on to FedEx. It's following on some of these other warnings. And they're all slightly different. Again, how much is this the beginning and how much is this an idiosyncratic shift by different companies? The other company that I am watching is Beyond Meat. I'm sorry, John, I had to do this. But it's just kind of an amazing story. The shares are up 1%. That's kind of not really the story. The story is that the chief operating officer was arrested on Saturday
Shouldn't laugh about this.
on allegations that he bit a man's nose during an argument after a college football game in Arkansas.
A college football game?
In a college football game. But the reason why so many people find this amusing is because it's a company that caters to vegans and people who don't want to eat meat. You know, he bit a man's nose. There are a lot of questions about this.
Does that mean he's no longer a vegan?
I don't know. You could debate the culinary meaning behind this, but a lot of people are looking at this as a sort of a story of note. It's interesting. The shares are up. The shares have been absolutely decimated over the past 9 months or so as people rethink the proposition for this company.
I'm not sure what the connection is there between the stock and that incident.
I don't really. Did you notice I didn't even try? I'm just sort of saying that the stocks are up, but it was a fascinating story. I felt like we had to kind of put it out there. It's kind of interesting.
Kathy Jones is here to weigh in. Chief Fixed Income Strategist at Charles Schwab. She's not. Kathy, stay with us. Don't worry, I'm not coming to you on that. Kathy, we all want to know. A 10-year through 350, a 2-year approaching 4%. Kathy, are these big buys, either one of them for you?
Well, we like extending duration here. I think it's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with, the economy slowing. We've had 6 months of declining LEI. We're seeing the housing market decline. These are unsustainable trends. At some stage of the game, the Fed will have to shift or we're just going to go into a deeper recession than we may already be in. And so we do like extending duration, albeit, rates could continue to move up, but I think all we're getting is a deeper and deeper inversion of the yield curve here.
And Kathy, this call on extended duration ultimately has to be a call on the economy rolling over. Do you have an idea of the pain threshold the Fed is willing to go through?
Well, I did mention pain for households and businesses last time, and I think there's a willingness to let it continue and worsen, particularly I think the Fed wants to see unemployment rise. They won't say that out loud, but I think they want to see labor conditions not as tight as the way that they'll put it, and they want to see wages slow down. Right now, average hourly earnings running about 5.2% year over year. It's leveled off, it's stabilized, but we haven't seen it decline. And I think their comfort zone is closer to 3% in terms of wage gains than 5%. So that is probably what they're willing to tolerate. The question is whether risk assets can tolerate that sort of pain.
Kathy, do you care about the dot plot?
Well, we have to, right, because they put it out there. But it's a moving target. I just look at it as a moment in time guesses. I'm not going to take it too seriously. I think it's a messaging tool. Simply, the Fed will show that they want to hike rates and keep them there for a long time, but it's a moving target.
Kathy, I ask this because there's a question about the credibility of this Federal Reserve, the credibility that they're actually coming up with a thesis that they can follow through on versus just following the market and doing what the market is dictating. How much has that shifted your view of how to operate and how much volatility is going to be injected in these markets at a time when the Fed is not leading anymore? It is apparently following much more what the market's already doing.
Yeah, I think the Fed is in a position now of actually following the inflation data. And we know that inflation is a lagging indicator. We know that monetary policy works with a lag. And so they've shifted instead of saying, hey, we're on top of this, we're taking action. We've got QT on top of a rapid tightening cycle. They've shifted instead of saying, okay, we know that what we're doing will make progress in the future to reacting to numbers that are coming out today. And that's why the risk is for a deeper and deeper slowdown in the economy. And this is compounded globally. We're seeing this all over the world. And that makes it even more of a problem for people who are trying to look forward and look at what the Fed is saying versus what the Fed is doing.
How much conviction do you have, Kathy? You were saying it is a good time to go into duration. How much conviction do you have that we've seen the highs or at some of the higher levels for longer term treasuries at a time when you're questioning whether or not we're actually already in a recession, let alone headed for one?
Yeah, we feel pretty confident moving out the curve. We're not all in buying, 30-year bonds or 10-year bonds here, but we do think that it's unsustainable. We're starting to see credit spreads widen a bit, the strains in the economy, the strains in the marketplace. Liquidity isn't what it used to be. And so you feel pretty confident that this is a time to start taking advantage of yields where you can lock in, an investment-grade portfolio. Right now, you can lock in 4 to 5% yields without taking a tremendous amount of duration risk. We think that that's a good alternative compared to some of the other asset classes out there.
Kathy, thank you. The brilliant Kathy Jones at Charles Schwab on the bond market. There's some buys out there in fixed income. Won't be the first time you hear that this morning. We'll catch up with Bob Michael at JP Morgan Asset Management as we can get down to the opening bell a little bit later. If you're lucky enough, fortunate enough to have access to a Bloomberg terminal, FedGo, and you get a quick snapshot of the forecast at the bottom of that page. The pain, Bramo, that we're talking about here, that the chairman of the Federal Reserve talked about in Jackson Hole, Wyoming, in that speech several weeks ago, do you think the forecast will begin to capture it? Unemployment at the moment for them, 3.7% year-end this year, 22, 23, 3.9%, 2024, 4.1%. That is, of course, painful for a lot of people to get that number out there. But there's a lot of people also looking at this situation and saying, Lisa, they need to see more pain than that to get inflation back towards target. Will they start to communicate that in their forecasts?
And if they don't, what does that mean about the credibility, about how much people actually trust that they're communicating the reality of what they're looking at? And the reason why this is really the discussion right now is because the fact that CPI came in hotter than expected, the real most important data point ahead of this meeting for the Federal Reserve, highlights that there perhaps is more momentum than people had expected, that you're not seeing the deceleration, the stickiness of rents, the stickiness of higher wages, the stickiness of medical bills, the stickiness of grocery bills, all of these basic items that people pay every day, they have to see decelerating in a way that's going to only happen with that pain. And you have to see them communicate that in some capacity.
They're forecasting a soft landing, aren't they? In the last round of projections. I hope they're right. Bank of America and Mike Gapin doesn't think they are. He thinks they're wrong. He thinks we're going to get a hard landing. And this projection, the next set of projections in the summary of economic projections, the forecast will have to capture that. Lisa, the risk of a hard landing. If we've got a whole host of guests, and the consensus may well be wrong, but increasingly the consensus is the landing strip for a soft landing is like this. Who said it yesterday? It's like landing a jumbo jet on a picnic blanket. Who was
That's
that
fantastic.
Yesterday?
I don't know.
I forget who said
fantastic.
that. It's all a blur to me. But someone said it and it wasn't me, so they'll get credit for it and I don't want it. But ultimately, it's very, very difficult to land this. And yet the Fed is projecting a soft landing based on its current set of forecasts.
It takes a great deal of luck, right? A lot of people have been saying that, and they're not getting that luck. The facts are not cooperating when you look at the gas prices. Although on the margins, you know, gasoline prices have come down dramatically, but how long will that last?
I think it was Nick Benenbrook of Wells Fargo.
On a picnic blanket?
Landing it on a picnic blanket. I think it was him that said it.
Is that unlikely or impossible?
I think it's impossible.
Let's just call it.
Unless you're like Tom Cruise, Maverick. Maybe he could do that.
All right, let's get him into the Fed and see what he could do.
54.54 on a 10-year. Yields up 5 basis points. Megan Green up a little bit later, 8:30 Eastern Time. Looking forward to that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The president of Turkey says Russia should return occupied territory to Ukraine as part of a peace treaty. Recep Tayyip Erdogan told PBS that he had very extensive discussions with Russia's Vladimir Putin last week. Erdogan says Putin had showed him that he's willing to end the war as soon as possible. Hurricane Fiona has exposed Puerto Rico's fragile power grid. The storm caused a general blackout that affected the entire U.S. territory of 3.1 million people. The power outages hit just as Puerto Rico's electric authority is dealing with a bankruptcy that has no clear end in sight. President Biden's vow to defend Taiwan with U.S. forces if China invades is making a U.S. policy shift explicit. A spokeswoman says the president's comments on CBS's 60 Minutes did not mean that the policy toward Taiwan had changed. But the remarks are being seen as a reversal of decades of so-called strategic ambiguity in which the U.S. refused to make its intentions clear. Morgan Stanley will pay U.S. regulators a $35 million fine over data security lapses. The SEC alleged that one of the bank's units failed to secure the personal data of millions of customers when replacing hard drives and servers. Morgan Stanley agreed to settle the case without admitting or denying the allegations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
started, I had no idea it was going to turn into this. Just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Headlines on Ukraine and Russia. Anne-Marie, back in the studio for us. AMH, what's the latest?
What we're hearing now from Moscow is they're going to have these special elections, a vote on joining Russia for the Luhansk region, and it's September 23rd through 27th. And this is according to Interfax, which is a state-run media agency in Russia. I spoke to Dmytro Kuleba, the Ukrainian foreign minister, yesterday, and he mentioned this region. He said it's the only region right now that Russia has full control over. So it would make sense, and this is really a playbook that Russia does. If they have full control over this region, they're going to have an election and just say that these individuals want to be part of Russia. We've seen for months Russia really try to do this in any territory where they're gaining grounds. And it's not just about we're going to set up an election and send propaganda in there, but also about introducing things like the ruble. So we've seen this in Crimea, we've seen it in a number of places, and now they're doing it in Luhansk.
Is it a stretch to suggest that this could be one way that the Russian leader claims success of the special operation, the so-called special operation?
I think that's exactly how a lot of people will view this. Putin has said, and he said to Xi Jinping, he still remains that he is in this, quote, special operation. Obviously, Ukraine, the Western world, all with our eyes are viewing this as a war, but potentially back home. And you have seen I'm not going to say a lot of pushback, but a little bit of individuals talking about the fact that we should be calling this a war. It is a war right now. I mean, the head of the Communist Party in the Duma, this is the individual that back in February floated the idea of recognizing Luhansk and Donetsk as separate entities Then President Putin went in and said he's going to have a special operation. That same individual recently said we should call this a war. That would potentially mean having to go through conscription, having to spend more money, but potentially Putin can use this. They can get control of Luhansk, and then he can claim that his quote-unquote special operation was in fact a success.
Happy to say that Maria Tadeo can join us now from Brussels. Maria, let's get your take on all of this. What's the significance of these headlines that just crossed in the last 20 minutes?
Look, Jonathan, it is very significant, and these are bold power moves coming out from the Russian Federation. I think for a week now, the question was, how would Russia respond to the gains made by the Ukrainian army that had been an embarrassment for the army in Russia? You're now seeing, as Anne-Marie mentioned, potentially this referendum happening in Lugansk, which of course Ukraine will never accept, and will say this is part of our territory in Ukraine, and we will never accept what we think is a fake referendum. But also, as Anne-Marie mentioned, there has been now rumors now for weeks in Russia that this now will have to shift from a special operation. And remember, Vladimir Putin always says these are professional soldiers. There would be no conscription. We move slowly because our soldiers are professional. They do not want to hit civilians. Of course, the reality on the ground is very different, but I think it does tell you a lot about the mood on the ground in Russia. And there's two things for me that are risky here for the Russians. One is when you go full war, you never know what the reaction of the people is going to be. There is a big difference between watching a war on television, like it's reality TV, to now being told, well, now pack your bags, you're going to Ukraine to fight. And then the other one is that if you really believe we could be anywhere near a peaceful resolution, this would escalate this, because the Ukrainians will say that is our territory. Anything that's diplomatic, if you attach it to the Russian Federation, is out of the question. This is still a war.
Well, and that raises a question, Anne-Marie, and I'd love your take on this when you're saying that perhaps this offers a potential to claim victory for Vladimir Putin. We just heard Maria say that it could be viewed as an escalation or escalate the conflict because the Ukrainians will not accept this. Is it viewed as an escalation or a potential endgame to the conflict if Russia can say, we have a victory, or Vladimir Putin says we have a victory and can walk away?
Well, Putin will use that victory at home, but as Maria makes the point, there is no way that Ukraine would accept this. And I just saw another headline, Interfax, saying it's not just Luhansk, but it's Donetsk. So he's going to have these special elections in both these individual entities to see if they will join Russia. And obviously, like Crimea, this will obviously be very fixed, not an actual election. It will be viewed potentially for Putin at home as a success, and then he can even use that as to get conscriptions of Russian soldiers, because that would then be Russian territory. But Ukraine would not accept this. So I don't see this as an end game, only that Putin can claim it as a success. And as Maria said, it was quite embarrassing, this counteroffensive that the Ukrainians had run in the Kharkiv area, and now they're moving that to the south. But this is certainly viewed, in my eyes, as an escalation.
Maria, how much cohesion is there among the European allies to really support Ukraine in combating this escalation as you see it in the next couple of months?
Yeah, and again, going back to the point also, I think to answer that question, you have to put yourself in the psyche of the Ukrainian people and the Ukrainian government. And if there's something Ukrainian officials repeat is that, A, they're not going to give away territory. If anything, they want to get Crimea back. And they also point to their international borders of 1991. That is what they would declare a victory. When you look at the European response to this, they will view it again as an escalation. And a lot of this precipitated the conflict back in February, that think this is Vladimir Putin back again with his old tricks. The idea of mediation working potentially once again, that would be out of the question for the European Union. And you heard it from the head of the European Commission last week in a speech that was very belligerent. We're going to stand with the Ukrainian people. And there's this one thing that she repeats all the time. This is now autocracy versus democracy. What they would consider a fake referendum would be once again another demonstration of what in the eyes of the European Union is Russian autocracy.
Can I squeeze one more in here? And Anne-Marie, perhaps you can respond to this. We heard from the Russian leader in the last week, and there was almost a nod towards the concerns that China had about the situation. How do you think that plays into this?
Well, I think he could take this to Beijing and say, this was my special military operation and I'm successful. That's what he's going to do for any allies he has now. I mean, who is that really? It's Xi Jinping, it's North Korea, and obviously take it back home. But it was also a rare, really, admission that he was making to President Xi, saying basically, we know we've put you in this difficult spot and you probably have some questions about what is going on.
MH, Maria Tadeo, two of the very best on this story. To both of you, thank you. Our lead paragraph in our write-up of this story, Bramo, reads as follows. The Kremlin is moving hastily to stage sham votes on annexing the regions of Ukraine its forces still control after Kyiv's military drove Russian troops from large areas of territory taken in their 7-month-old invasion.
Yeah, I think it's really important to get the context. This could be viewed as an escalation since Ukraine will not accept this. It will just create more red lines and more motivation to combat what we're calling in our story sham votes. How does the U.S. respond? And I do wonder, some of the European allies, as they face off with a very difficult winter, how much unity there is to really provide that support to Ukraine.
Quite a time for global leaders to convene in New York City for the UN General Assembly, isn't it?
Well, how much is this an oil and gas summit? I mean, at a certain point, how much is this the energy summit to try to figure out how to stave off a really difficult winter?
And Maria will continue to provide coverage of this story through today on Bloomberg TV and on Bloomberg Radio. We'll stay on top of the markets too. We're down 4/10 on the S&P 500. Alicia Levine of BNY Mellon will be joining us very, very shortly with futures down and yields higher by 5 basis points. Your 10-year in America, 354.34 from New York. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
The U.S. economy is going to have to endure a period of elevated interest rates in order to tackle inflation. Inflation's the worst problem here.
It's going to be hard to get that longer-term inflation under control without a significant disruption to near-term growth.
We still got to get to the next CPI print before you can have any sort of clarity at this point. I think we all know where the data is headed as the official data catches up, and it's going to be weak, and it's going to be a little bit scary.
I feel like the market has gotten a little bit ahead of itself.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bond yields are still climbing, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back with us for Fed Decision Day tomorrow. Going into that Fed decision, equities down 0.5%. Lisa, yields higher, much higher.
You're saying bond yields still higher. They're going higher still. I mean, I feel like it's sort of been a broken record, not by you, but just in general.
You can call me a broken record
over the
if you
past 2
want.
weeks. I'm not saying you're a broken record, but it's been kind of a one steady node over the past couple of weeks. And at what point do we reach the end? At what point does something break? We've seen just sort of a slow bleed on the other side in equity valuations, but it hasn't been dramatic. And that really is interesting to me, that resilience, that lack of a complete collapse in the face of yields that were unthinkable a year or two ago.
If I sound like a broken record, it's because we've had 9 days of it now.
I'm
on a
not
2-year.
saying
9 straight days. I'm happy to be called a broken record. So many people right now agree with you. It's fine. He is a broken record.
No one is saying they're a broken record.
Someone at home is. They're just doing it. I'm paranoid anyway.
Carry on.
Nothing's wrong here. We're all okay.
Yeah,
4% on twos just around the corner on a nominal yield. The real yield on a 10-year. Lisa, it's not just nominals, it's real too. The real yield, the highest since 2011.
And I keep asking this question. I've been a broken record on this. At what point does this become an alternative to equities? And we are going to ask our next guest about this, but we've really been hearing about this idea of you actually can stay in cash and earn something. And at what point does that create that lost decade that Chris Verone was talking about in equities, because people are fine hanging in there and just clipping coupons?
We've asked the question, haven't we, a million times? If we're 50 basis points higher at the front end versus where we were on June 14th and still 6% higher from the lows on June 16th in the equity market, does it open up a retest of the lows? And let's face it, it's not a big call to say that anymore if we're 5-6 percentage points away.
I would agree. The question is where the loss is going to come from, because you've seen certain names absolutely blown out already. And some of the stories are specific. And Chris Verone, I keep going back to this, was mentioning Meta, Facebook. I know that, Tom, if you were here, would rail at me and say, I can't believe you would call it Meta. It's not Meta, it's Facebook. What does Meta even mean? But it's been a complete evisceration of the valuation at a time when people are worried about advertising, worried about a business model, and worried about bringing forward revenues from an era where we're already seeing low rates completely upend, or just the fact that we have higher rates completely upend the presumptions from the low rate era.
We both spend a lot of time reading research on the South Side. I know you read as much as I do, perhaps more. It's interesting to see the big equity market bulls now, not talking about upside potential, but talking about limited downside. And this was from Marko Kolanovic of JP Morgan, who is still bullish, but said this: robust earnings, low investor positioning, and well-anchored long-term inflation expectations should mitigate any downside in risk assets from here. Is that where the conversation is now for the bulls, Bramo, that it's about limited downside risk and no longer about big upside potential?
Is this the most constructive way for you to sort of raise a question of whether this is the most bearish Marko Kolanovic has gotten, that he's basically just talking about limited downside, given the fact that he's been such a screaming bull for so long? Maybe. I do think about what the potential for accidents are, right? And I think that perhaps is what he's responding to. There is a fear that something breaks when things move this quickly, when you have a complete reset of some of the presumptions, and a lot of people are keeping their eye on Japan. And what happens if you have suddenly a wholesale rethink of a bond market that has not been a market for decades?
It's been capped at 25 basis points at the upper end on yield curve control in Japan. Chris Verone of Strategas a couple of hours ago on this program, signaling that he thinks maybe that could break. What we all ask is what the dominoes are, how they fall from there. Lisa, can you imagine they step away from yield curve control? And thank you to the individual that wrote to me about this in the last week or so. It could cause a lot of problems in this bond market.
I keep going back to a couple of different strategists we've had on who say that that is the trigger, that is the difference between a 3.5% 10-year yield in the U.S. and a 5%.
Oh, 5?
Yeah. Some people are saying even 5, that's where you start to see yields that climb dramatically. Maybe not stay there, but really that's where the fissures start to come into place as suddenly some of those foreign investors have a reason domestically to buy.
I wonder where it would leave this equity market. Certainly not here. We're down 0.5% on the S&P. On the Nasdaq, we're down about 0.6%. Squeezed out a day of gains yesterday. Can we do the same a little bit later this afternoon? Yields are higher by 5 basis points, 354.54. Let's get straight to Alicia Levine, the head of equities and capital market advisory at BNY Mellon Wealth Management. Alicia, how big is the risk that we're heading back towards something like 3,400?
Look, I think it's a 50% odds on that we go there, simply because all year the equity market has really been following the bond market here, and as 10-year yields move higher and push through 3.5%, that's our trigger for another move lower from here. So when 3,900 couldn't hold, which was sort of that last vestige of support where there was a lot of supply and a lot of trading previously technically, when that didn't hold, it was just kind of clear that as you move bond yields up, equity markets are going lower, and really for good reason, because the top of the market are high growth and tech stocks where the valuations will come down as yields move higher. So it's a neat little equation. Unfortunately, it's playing out, and that opens up downside from here. But as you say, that 366, the June 17th low, is not that far away from here. It's not a heroic call to say that anymore.
Are we pricing in the weakness that we're hearing from the likes of Ford, from the likes of FedEx, that already are starting to sound some profit warnings?
So in an interesting way, your conversation about how does this conversation change, right? How do we move higher from here? It is our view that the way the equity market can climb out of this hole that it's kind of gotten itself in is for estimates to finally come down and for realistically to price in the slowdown in growth, because it's all been driven by yields. Even now, estimates are holding in there. The forward 12-month on the S&P is something like 17 times, and if you take energy out of it, it's 19 times. That is not a cheap market, and it's not a market reflecting a slowdown in growth. That has to happen, and I think if you realistically reset growth expectations and earnings, then you can begin to bottom. But until that happens wholesale, then I think we're sort of stuck in this purgatory for a while.
So this is the part of the conversation where equity strategists wear their bond hats, because it's all about rates, and this is what we've been seeing for a long time. And so you have to come up with a call of whether we're getting to peak hawkishness, whether people are already pricing in more than the Fed could potentially do. Do you have a call on that? Is that something that you want to game out, or is there some kind of relative trade that seems a little bit more insulated from those macro guessing games?
Great question. I think that the risk is actually to more hawkishness here, simply because if you think about that CPI print was pretty devastating for the Fed dot plots, I think, and for the terminal rate on the Fed funds. So that likely goes higher. If that goes higher, multiples get compressed further, but that hasn't happened yet. So I think there is some thought that we're getting to peak hawkishness, but that's not going to move the market now. It's the earnings that are going to move the market, and a realistic reset of where we're going in this. So yes, there are relative valuations. Look, in the end, this is a short duration market. It has been a short duration market. Same in equities, and not just in bonds. So we still like that utilities are fine. Some staples are fine. Safety is fine. We love real assets. We are, allocating our clients to real assets because we do think we are in a regime change where inflation remains higher for longer and rates remain higher for longer as a result. And all you have to do is listen to some of the workers' strikes that are going on out there, what happened with the rail strike. I mean, these are huge wage increases. This is a change for the economy, and the rates are going to reflect that going forward. I don't think we're going back to a world where you have 1% yields on the 10-year and let's have a party and buy high growth, no earning tech stocks. So we're still in that short duration world. And to your question, are bonds an alternative? Not on the long end, but on the short end, they certainly are doing better. And whether a 4% yield on a 2-year is fully reflecting inflation on a real basis, it is not, but it's sure a lot better than losing money in the equity market.
Alicia, just quickly, what's your time horizon for all of this? It's so well put together. When you start thinking about these issues sticking with us for longer, how much longer? Are we talking years? Are we talking 5, 10? What is it?
So, look, I was trained as a historian, and I look at things in big picture ways. In the short term, I think we get a nice bump coming out of the election, okay? Mid-year elections are notoriously difficult leading up to it, and you never lose money in the 12-month after the election since 1942. So we likely have a rally coming out of the election, and it could be sustainable because we'll get to that peak nastiness heading into it, right? We have terrible seasonality now, better seasonality by the end of the year. So we're optimistic for how this year can stabilize and move higher. Looking forward, I think you have to have a more intellectual view of where yields can be and where the market is and where we can grow. And one of my favorite things to do is just look at, the top 10 stocks of the S&P or the top 10 stocks of the Dow, the beginning of every decade, to see the change of where capital is being allocated and what the growth companies are. And I think you can make a good case that some of these large cap tech is where the risk is here.
Let's just avoid the Dow. Just stick to the S&P. Don't encourage Tom. Don't encourage
Honestly,
Tom. Isn't
some
Alicia
people
great?
do that.
One of the best. Alicia Levine of Win Wine Mellon.
That was fabulous.
Wealth Management. Tech stocks don't work in Alicia's world. That world is a scary place for tech names, that's for sure.
What does that mean then for total return for the S&P and the NASDAQ in particular, given their weighting?
Precisely. Futures down 0.6, yields higher from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers today will begin a 2-day meeting that's expected to end with another jumbo interest rate hike. According to economists surveyed by Bloomberg, the Fed will hike its benchmark interest rate by 0.75 percentage point for the third straight time. Chair Jerome Powell has made it clear the Fed is committed to curbing inflation sooner rather than later. In Japan, inflation has accelerated to the fastest pace in more than 3 decades, and that creates headaches for the Bank of Japan. It will try to explain why it needs to continue with monetary stimulus when inflation is above its 2% goal. Consumer prices, excluding fresh food, rose 2.8% in August from a year ago. Britain's new Prime Minister Liz Truss says that a trade deal between the UK and the US is unlikely in the short to medium term. She says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting for the UN General Assembly. Bloomberg's learned that Germany is closing in on a deal to nationalize gas giant Uniper. Contracts haven't been signed, but Berlin is aiming for an announcement this week. Germany has been working on a historic takeover of 3 large gas importers to prevent a collapse of its energy market. Morgan Stanley will pay U.S. regulators a $35 million fine over data security lapses. The SEC alleged that one of the bank's units failed to secure the personal data of millions of customers when replacing hard drives and servers. Morgan Stanley agreed to settle the case without admitting or denying the allegations. Global news 24 hours a day on Bloomberg and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
Strong dollar, I don't think is a problem or an issue for the Federal Reserve, United States policymakers, but it is becoming at least a bothersome, I would say, for many foreign central banks.
Nick Benenbrook there, the Wells Fargo international economist. Many foreign central banks making decisions this week. The Riksbank out earlier this morning from Sweden with a 100 basis point hike. The Swiss National Bank later this week. The Bank of England later this week, following the Federal Reserve tomorrow. From New York City this morning, good morning. Lisa Abramowitz and Jonathan Ferro. TK back with us tomorrow morning. Going into tomorrow, any Federal Reserve decision, futures down, equity softer, negative 0.6% on the S&P, on the Nasdaq, down 6 or 0.7%, 354.54 on a 10-year, yields up 5 basis points. Unsurprisingly, Lisa, people on the program already today, Kathy Jones and Charles Schwab being one, talking up why you might want to buy a 10-year at 355.
Right, which follows a lot of discussion about peak yields earlier in the yield, but nonetheless, people saying that eventually there will be a recession, if not caused by monetary policy, certainly caused by a confluence of events. You're talking about the Riksbank over in Sweden. What I find interesting is the krona is actually the weakest that it's been versus the dollar going back to 2001. That some of these moves are not necessarily being effective in terms of supporting the currencies. And this really has been a theme that we've seen certainly in Britain and elsewhere.
Sterling, a decent example of that, going into the BOE on Thursday. Here are some calls for you. Euro and sterling, 96 on euro dollars the call. On sterling on cable, 111. That call from Mark McCormick, Global Head of FX Strategy at TD Securities. Mark, I think people itching to fade some of this dollar strength. Would you suggest they should do that? And how would you suggest they go about doing it?
So yeah, that's a great question, because I do think we are slightly transitioning through narratives and FX. I would absolutely not fade the core G10 weakness that we see in euro, sterling. You talked about Stocky and even Norway. Those currencies are probably set to weaken and continue lower. I do think that we are getting into an interesting place where we can selectively look at emerging market currencies and see some value there. Carry's becoming more important, likely because interest rate volatility is starting to peak. And what's really interesting is that while we are still kind of exploring the Fed's terminal rate, which is now at 4.5, and then maybe it's at 4.75 in a week from now, but what we're seeing is we saw a very significant amount of tightening of financial conditions and repricing of volatility over the last year. So incrementally, we're not getting more shocks to rates volatility. So what we're starting to see is like data surprises are starting to improve. We're starting to see a little less volatility come through on the rate side, and people are getting interested in more emerging markets that offer the yield, like Mexico, Brazil, Indonesia, even India. And a turn in the global commodity cycle would also be very interesting for some of these Asian currencies that offer attractive yields in this environment.
Mark, how much work have those central banks of those currencies, how much work have they done before the Fed even got started?
Well, a lot of them, as you know, like the central banks in Latin America are operating. They have to maintain credibility, so they kind of have to front load, and they have to raise real rates much higher than they would across the U.S. So you're getting a real yield pickup in a lot of these places. And again, you have not had the same stagflationary environment in Mexico and Brazil. And you could actually see that Latin America has been a little bit more insulated from the global stagflationary conditions than every other country in the world. And as you mentioned as well, with policy divergence, in Asia, it's all about the easing of financial conditions. They're dealing with disinflationary pressures versus what the U.S. has, which is they have to deal with tightening of financial conditions and the inflationary pressures. And the Eurozone in Europe in general is dealing with basically an implosion of financial conditions that's been dropped on it. So everyone around the world is kind of operating very, very differently in this environment. That's what's kind of creating a lot of this interest in different currencies in Asia, in Europe, and also in the Americas.
John's question made me think about how much work certain nations did in advance and how much catch-up certain nations are doing now, and how ineffective some of that catch-up will be, given the fact that you still do see, for example, the krona continuing to weaken despite the recent rate hike, and you see the euro continuing to really flirt with that parity and below levels. How much are rate hikes going to be counterproductive to strengthen these currencies because of the damage that they will do to the economy?
That's a great question, because I think part of the credibility that's been lost for the European central banks is again, it's not entirely their fault. You are dealing with an external shock that's come through on the financial conditions, and it's also come through on the terms of trade side, which is essentially are importing a massive energy bill that is a one-off temporary shock. So break-evens in the Eurozone, in UK, and also we don't have like a good liquidity and break-evens for Sweden, but inflation expectations across Europe are continuing to surge. And particularly, again, if we look at break-evens like as proxies for inflation, and the central banks can't raise rates fast enough in the short term. And the concern is again, now we're getting fiscal stimulus. We're getting a tremendous amount of fiscal stimulus in the UK. We're getting fiscal stimulus in the Eurozone. And that is counterproductive for real rates, which in the US are moving to the highest levels we've seen on 2-year front-end real rates are basically close to 2%, depending on how you measure this. So right now, what the FX market's responding to is a terms of trade shock, which is creating winners and losers on the real rate space. And Europe's central banks just can't keep up with the inflationary shock that's been imposed on them. And the Fed is doing a better job, not because they've got more credibility, it's just that they're handling domestic inflationary pressures, which is basically a result of the pandemic, fiscal stimulus, and also the existing folks who have left the labor market, which is again dealing with the wage concerns. So there's completely different shocks. But I think what you're starting to see is the ECB's gotten ahead of it a little faster. The Bank of England is lagging the most. And again, with the Riksbank, with inflation expectations, they're just not where they should be.
We'll hear from Governor Bailey this Thursday of the Bank of England. Mark, thank you, buddy. Always good to catch up. Mark McCormick there of TD Securities, starting to think about what to do with EM and maybe fade some of that dollar strength selectively. We're starting to think about a steeper yield curve this morning. Yields higher at the long end, but on a 10-year by 7 basis points to 356. On a 30-year, by 6 or 7 basis points as well. Lisa, got a bit of a breakout on our hands this morning.
Yeah, it's the highest levels that we've seen going back to 2014. It's interesting to see this kind of activity at a time when people are talking about recession, when they're saying that the front end is doing a lot of the work and is going to cause pain that is going to lead to a new reality of slower inflation. And this goes to Alicia Levine's point, where she was saying this is a new regime. She's recommending real assets because the actual stuff is getting more expensive. And you wonder whether people have accurately priced that into some of their market valuations, if we really are seeing higher for longer, not lower for longer, after a decade of the opposite.
It's the duration of this call that I think we're all trying to get a better idea of. How long are we going to have to live with this for? How long will it take?
The fact that you are seeing the long end rise is fascinating because it suggests a lot longer than people had thought just a month ago.
Equity futures down 0.7% on the S&P, and the Nasdaq we're down 0.8%. Coming up, Becca Green of the Kroll Institute from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
however you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Some economic data just seconds away on the housing sector, that industry here in America. Mike McKee's going to break that down for you. Going into it, futures down 0.8% on the S&P, another leg lower on the NASDAQ. We're down by 0.8% also. With your data, here's Mike McKee.
Well, this is a little bit unexpected, John. Housing starts in the month of August rose by 12.2% after falling 9.6% the month prior. So it looks like builders maybe trying to get some more stuff in the ground before the housing market completely dries up. Building permits reflect the idea that it is going to, because they're down 10% after a 0.6 decline the month before. So a big drop in what builders think is going to happen or are planning to make happen, compared with a big rise in what they're making happen. And it's also August, so maybe the last weather chance for them to get things through. Privately owned completions, private housing completions at a 5.4% drop below July. So the number of houses that are being finished is also falling. So in all, it is a picture of an industry that is slowing significantly, and no doubt because the Fed has raised interest rates and mortgage rates are now above 6%.
And yields are going higher again on a 10-year by 6 or 7 basis points. No big change off the back of this data. Your 10-year 356, your 2-year 396, up 2 basis points. Your equity market down 0.7% on the S&P. On the Nasdaq 100 down about 0.8%. Mike, the Fed and Chairman Powell talked about the totality of the data. We've got all the data now. What does it mean for tomorrow?
It means 75. They're focused on inflation, so it was the CPI report that is going to be most influential for them. We have seen in some of the other data, PMIs especially, some drops in prices paid and some indications that maybe we're seeing some inflation peel back. The CoreLogic people put out a report today that said rent prices have started to slow their increases. So in the long run, that will help. But for right now, where they are with the core CPI and core PCE, they're going to move 75 and give the same message to the markets that Jay Powell did in Jackson Hole. We continue.
Mike, as you prepare your question that will inevitably come at the end of the news conference tomorrow after Jay Powell speaks, and you really grill him, how much are you focused on the balance sheet and what they do with the mortgages that they have, whether they're going to unwind that?
That's an interesting question, and it's being talked about more and more in the markets, Lisa, but the feeling is the Fed's not going to address it at this meeting because they've got the 75 and they want people to focus on the idea that they're going to keep going on rates. They also have the SEP, the new projections and the dot plot. So a lot going on there, but there is a feeling that maybe they're not going to be able to shrink the balance sheet as far and as much as they thought they were going to, and that they might have to sell off some mortgages because at this point nobody is selling and nobody is refinancing. So those are questions, but maybe down the road a little bit.
You in DC tomorrow, Mike?
Absolutely.
In the news conference, looking forward to it. Bob Michael's joining me later. Bob Michael, every time he joins us, he likes to give Mike McKee a question to ask Chairman Powell. So look out for that a little bit later, Mike. Joining us now is Megan Green of the Kroll Institute and Senior Fellow at Brown University. Megan, can we just start here? And I think it's really about the economic data and how much this Fed needs to do to get growth below potential and ultimately get inflation lower. Is 4% it?
No, and actually, John, you asked me this a month and a half ago, I think, on your show, and I thought that the Fed would never get to 4%, but I've changed that view. They certainly will, and probably by the end of this year. I think they're going to have to go higher at the beginning of next year, but then I think they'll pause. I also think they'll slow down their rate hikes the further they get away from the neutral rate, which, we don't know exactly where it is, but we do know that we're probably close to it now. So as Mike said, I expect a 75 basis point hike later this week. I expect another 75 basis point hike later this year. That'll bring us to 4 by the end of the year. And then we may have an extra hike in the first quarter of next year, but I don't think they'll continue at 75 basis points. I think they'll start to slow down as they're already going to be in restrictive territory.
Is the transmission mechanism of higher yields effective this time around? And we talk about the lag time of how long it takes before this actually starts to slow inflation. From your vantage point, is it too slow? Are they going too far based on just trying to do something, at least now?
Yeah, so that is a question, Lisa, and it's not just a question in terms of what the Fed's doing, but if we take a more global perspective, most major central banks are tightening pretty significantly. I mean, the Riksbank is a good example today. The Bank of England will be tightening pretty aggressively, I think, later this week. And so there is a question about when you have this kind of coordinated tightening, what the knock-on effects are, whether it creates sort of a spiral. And I do think the slowdown could be more significant than many economists are expecting. We're already seeing some slowdown in the housing market in the US. That's by design, right? Higher rates are supposed to take the heat out of the housing market, out of car loans, credit cards as well. So that should start to slow the economy. But we've had a lot of aggressive rate hikes. They'll kick in with a lag, and that's a lot for an economy to digest. And so we may see trouble, not just because we've had rate hikes in the U.S., but because pretty much everywhere but China is hiking rates now.
A lot of companies, though, have taken this time to push out their maturities so that they don't have to borrow in the near term. And you do see a lot of people with fixed-rate mortgages that have locked in their levels for the low-rate period, and they're not going to be that effective. Is there a problem with transmission? Is there an issue with the Fed being able to raise rates much higher than people previously thought and not shake the economy? And that's completely changed the expectation for how high rates could remain over a longer term.
So that could be the case. I would also say adding to that is the massive cash buffer that's been built up over the course of the pandemic, both amongst households in aggregate and also among corporates. I mean, loan defaults are at record lows. And so it's going to take a while before we see a real pinch to kick in for consumers and companies on the basis of higher rates. That being said, when consumers finally retrench, is a question more of psychology than it is economics. And we don't actually have a great answer. Is it enough for them to know that a recession is coming to retrench, or do they actually have to experience the recession? We don't have a great answer for that, but we do know there's a lot of cash in the U.S. economy because of the pandemic response stimulus measures. And so that should provide a bit of a buffer and means that the Fed can hike aggressively before pitching us into a recession. So I don't actually expect a recession in the U.S. Before the middle of next year, which I think is a bit later than some other economists are calling.
How does that stack up versus Europe, Megan? You've just been there. How bad is it?
Yeah, Europe looks a lot worse. I think Europe will be in contraction by the end of this year. The second quarter outperformed relative to expectations. I think the third quarter can be buoyed by a banner tourism year in the peripheral countries, the southern European countries. But the last quarter of this year, I think, is going to be pretty ugly, in part because of high energy costs. And I think Europe will be in recession next year, early next year already.
How much are U.S. companies going to be exposed to the slowdown, not only in Europe, and you also have written a number of pieces about China and some of the problems there. How exposed is the U.S. in ways that people are not counting for?
So I actually think China, the slowdown in China is probably a bigger deal for U.S. companies than Europe. It's probably a bigger deal, not just because part of the slowdown is driven by a zero COVID policy that I think President Xi will have a hard time pivoting from for a number of reasons. So we may have some form of zero COVID for a while. That's causing all kinds of factory closures, supply chain disruptions that will continue to impact U.S. businesses, but also because China is just such a huge market for some U.S. businesses and a huge source of global demand. I mean, I think Bloomberg consensus has China growing by 3.5% this year. That's a hard landing, certainly. We'll see more stimulus coming out of China after the Party Congress, but a lot of that stimulus will be pushing on a string. I mean, you can only do so much to push out credit when no one wants to borrow, and I think confidence will be low, consumer and business confidence in China for a while. So I don't think that stimulus will really kick in until next year at some point. So I think it's the China slowdown that's being underestimated in the markets and will impact on U.S. companies pretty significantly.
Megan, thank you for that. We appreciate it. Megan Green there of the Kroll Institute. Megan not alone on that front. I think it was Nomura that came out several months ago and said 2-handle on Chinese GDP this year. Consensus on ECFC on the Bloomberg terminal, 3.5 for 22. Just to pick up on what Megan was saying. And Lisa, 5.2 for 23, 5% for 24. I can't get to the end of the year, never mind get to 2024, so we can disregard that. 3.5%. A lot of people going into their low threes on China for this year.
And there is a speculation, as we heard from Bill Lee over at Milken, of whether that is inflated, whether people don't go below 3% because they don't want to incur the ire of the People's Party, the Congress in China. How much, though, can they pivot from zero COVID? And I point to what happened in Hong Kong, where they're actually trying to reduce some of the quarantining rules to open up more to the world. And mainland China is okay with that. You know, I wonder if that's something like a petri dish, them trying to figure out what it would look like to remove some of these restrictions and open up a little bit more at a time when there's a lot of social angst and uprising about what they've been doing.
How much of a change will that be if you're cutting hotel quarantine but still monitoring people at home?
It's a pretty big change. I've had a friend go over to Hong Kong, and it's a pretty significant thing to have to stay in a hotel and not leave the hotel for days on end and have people cater to you and then get a certificate at the end saying, I completed my quarantine time, versus be able to go out or
that's
be
how
home.
they feel at the end of it.
No, literally,
Bouncing
they actually get a certificate.
That's ridiculous.
I mean, well, that's what they're
And
doing.
a medal.
Yeah.
Sure.
I survived quarantine.
I can't believe
Hong
we're still
Kong.
doing this 2 years later, but
Well,
here we are.
And what would happen if they reduced that, if they actually eliminated some of the zero COVID?
To the commodity market.
Yeah.
To crude. Ellen Wald was talking about that. Amin Nasser at Saudi Aramco talking about these problems going on for a whole lot longer than just one winter, Lisa.
Yeah, it's going to be an issue, and I do wonder how much we're pricing that in at a time when we can't really get to the end of the year. You're right to say that. I love how you just reject it outright. You're just like, I'm not going to see that far, so it's wrong.
Can you get to the end of the year?
No,
I can't get to the end of the year.
I can't even get to the next month. Are you kidding?
I can't get to next week or tomorrow or 20 minutes away.
I was about to say.
Bob Michael at JP Morgan, Victoria Fernandez
You can get there.
of Crossmark. I can get there. I'm racing there. And Sarah Hunt of Alpine Woods to guide you through the opening bout. They shouldn't leave the two of us alone. It's just so gloomy this morning, honestly.
I know,
just
seriously.
need TKs.
Isn't it with like a smile?
Dreamful views on the future.
Untang.
And a better time many decades ago.
They're going to adapt and adjust.
Futures down 6 or 7/10%. Isn't that a favourite line of his? They'll adapt and adjust. From New York, adapting and adjusting. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The president of Turkey says Russia should return occupied territory to Ukraine as part of a peace treaty. Recep Tayyip Erdogan told PBS that he had a very extensive discussion with Russia's Vladimir Putin last week. Erdogan says Putin has showed him that he's willing to end the war as soon as possible. Hurricane Fiona has exposed Puerto Rico's fragile power grid. The storm caused a general blackout that affected the entire U.S. territory of 3.1 million people. The power outages hit just as Puerto Rico's Electric Power Authority is dealing with a bankruptcy that has no clear end in sight. Well, NASDAQ is making its first major push into crypto. The second largest stock exchange will initially offer custody services for Bitcoin and Ether to institutional clients. Now, NASDAQ would be competing with crypto firms such as Coinbase, Anchorage Digital, and BitGo. In China, Tesla's Shanghai factory has finished upgrading production lines so it can double output to 1 million vehicles a year. The Shanghai plant accounted for half of Tesla's deliveries last year. It went to extraordinary lengths to keep the factory running during Shanghai's COVID lockdown. Switch watch exports are on the rise. The Federation of the Swiss watch industry says exports increased 15% to $1.8 billion in August. That's the fastest pace in 6 months. The most popular shipments included the relatively cheap Swatch Group's Omega Moonswatch. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
I think the Fed wants to see unemployment rise. They won't say that out loud, but I think they want to see labor conditions not as tight as the way that they'll put it, and they want to see wages slow down. The question is whether risk assets can tolerate that sort of pain.
Some of the big questions, Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, as we look at short-term yields rising to the highest levels that we've seen going back to 2007, really bumping up against that 4% level. We're looking right now at a further deterioration in equity futures ahead of the open with about 40 minutes to go. Really, the NASDAQ seeing more significant losses, the S&P down 0.7%. People looking at some of those tech-sensitive stocks is really driving some of the losses there. Euro, once again, below parity, 99.64, and that 10-year yield reaching the highest level going back to 2011. Have we reached peak yields? The housing market very much in the forefront as we watch yields rise because mortgage rates have been climbing so significantly, and there's no one better to speak to this than Jonathan Miller, who has decades studying the industry, president and CEO of Miller Samuel. He always puts out these fantastic reports that gives these real deep dives into what's actually happening on the ground. And we're talking about the pain. We're talking about home builder sentiment rolling over yesterday. We're talking about what it means to have a mortgage rate at 6%, and you are still seeing bidding wars. Are we underestimating the demand, the strength in this housing market?
Well, absolutely. Before the Fed was raising rates, bidding wars in most of the markets we cover across the country were somewhere in the neighborhood of 50% of all transactions. Southern California was 2/3 of transactions. There's still bidding wars now, so it's just much more muted. I think the the narrative is that, you can hear crickets, and that is not the case. It's just not what it was, and what it wasn't sustainable.
But how much are we speaking about idiosyncratic markets, right? I mean, the market in Connecticut, for example, very different than the market in Phoenix, Arizona, or the market in San Francisco. How much are we seeing potholes where you are seeing wholesale declines in prices in some areas, particularly the Sun Belt darlings, whereas other areas are holding in more significantly?
I think the chatter on pricing is more about sellers cutting asking prices more than wholesale price declines throughout a region. In aggregate in these regions, because inventory is so low, even with the increases that we've seen, there's a fairly firm underpinning underpriced. It's certainly, I'm not saying we're not looking at some sort of price decline a couple quarters out, or sometime in 2023, but I don't see this as a correction scenario, because the market was wildly overweighted on the demand side going into this, and inventory was literally obliterated. A typical market, a sub-market might have 200 listings. Just before the Fed rate increase in the beginning of the year, there might have been 10 listings, 12 listings. Now there's 50. It's still 75% below. I mean, that's sort of the scenario we're seeing in the different markets that we cover.
But just to push back, we're seeing just the volume of sales drop off a cliff. And a lot of times that's a precursor to price drops that are more substantial, right? It really is a matter of where people are willing to transact, especially if their all-in borrowing costs are rising by hundreds of dollars a month. I mean, at what point does that housing, the sales slowdown translate into something materially in price?
Yeah, so typically there's an average of about a 15-month lag between sales correction and some kind of price decline. I think what many people get wrong in a market pivot like this is the scenario is external event, sales activity falls, then inventory rises, and then because there's more supply, prices correct. But housing prices are sticky on the downside, that they take longer to fall than they do to rise. And we're in that sort of discovery period right now. But what's different is that supply in general is still relatively low as compared to historical norms.
Jonathan, you were talking about how just because rent increases are slowing down doesn't mean you're going to see a decline in rents. And you've talked before how rents typically are pretty sticky, that they don't go down that much.
Right.
Does that mean that the transmission mechanism of mortgage rates where they are is going to be largely ineffective at bringing down some of the base costs, like rents, like housing prices, that people are imagining is the case?
Right. I think, housing is about 30% of CPI, and it's owner's equivalent rent. It's not, any kind of correction in housing equivalent rent. And effectively what's been happening is you have a slowdown in the sales market, and largely because of the loss of affordability with a spike in mortgage rates. Mortgage rates are literally double what they were at the end of December. And the scenario ends up, you're pushing those people into the rental market, which is already tight, which keeps rent elevated, which makes me worry that the Fed path is going to be longer than we think in terms of pressing rates higher.
How high could mortgage rates go in your view?
Who knows? I'm not. It's funny. About a year ago, I was basically saying that rates should be in the fives. That would be a more normalized market, maybe the sixes. I'm skeptical that they can leave the sixes, but I still think there's some upward movement going forward. There's no, barring a recession. I mean, the idea that the Fed is taking a baseball bat to the economy is something that has to factor in housing, since it's so large. And I'm not sure if that's going to be effective just because of the owner's equivalent rent calculation driving rents or keeping rents high. The opposite of rising rents is not falling rents. It's stabilizing rents, in my view. And the only thing that's going to bring rents down is going to be some sort of recession, at least at this point.
Jonathan, 20 seconds. Have we overdone the back to cities trend, or is that going to continue?
I think it stays where it is. It's pretty close to that. This is not returning to the mean sort of scenario. We've been working from home too long for this pattern to go away.
Jonathan Miller of Miller Samuel, thank you so much for being with us. I always love speaking with you and your insights in the housing market, especially at a time when so many people say this is the best example of the efficacy of a Fed policy, of tightening policy, of higher rates. And Jonathan Miller casting a little bit of cold water on that and saying, actually, it hasn't slowed that much because it isn't as interest rate sensitive as many people think. Coming up on Balance of Power on Bloomberg TV and radio, Congressman Chris Van Hollen, Democrat from Maryland, as we count down to the elections, as we look to President Biden's speech later today, tomorrow, as he comes to New York City for the United Nations General Assembly. From New York, this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by these flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
making new highs in the bond market once again for 2022. Live from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, counting down to Chair Powell.
Chairman Powell.
Jay Powell.
Looking to hear from Chair Powell.
For right now, the Fed is kind of driving the ship.
The reality is Powell is extremely hawkish.
We have the all-important Fed meeting. Powell might have to thread the needle and try to sort of talk the market away from the ledge.
Investors have to remember the Fed does not care about the stock market.
The hot core CPI print that we saw on Tuesday.
The Fed has a lot of work ahead of itself.
We are expecting 75
basis points.
The Fed isn't going to blink.
The right thing to do, again, is to stamp out inflation.
Credibility is based on that fact alone.
There clearly isn't going to be a pivot anytime soon.
There will be, of course, a lot of focus, not just on the move itself, but on the message that accompanies it.
Joining us now is Crossmark's Victoria Fernandez and JP Morgan Asset Management's Bob Michael. To the both of you, thanks for being with us. And let's start with this bond market. A 10-year at 3.55, a 2-year approaching 4%. Can I get your view on this, Victoria? How much of a buy is that?
Well, look, I mean, as you're speaking to someone that actually manages some taxable fixed income, I think you have an opportunity here. We look, and you've been talking all morning about the percentage of S&P stocks that are, their dividend yield is compared to the 2-year Treasury. I think there's only 16% that are above that. So I think you do have a buying opportunity. We're actually buying in the fixed income markets, but now we're buying longer duration. We've been short duration for years. And so we've been lengthening that duration, going out the yield curve, but really kind of doing a barbell approach, Jonathan. We like the yield you're getting on the 2-year, but we want to go further out the curve and extend that duration. So doing a barbell there. I think you do have a little bit of an opportunity. The TINA component is not completely in play at this point because there are other opportunities. And I think you can also leave a little bit more in cash than you have previously because we are going to have some volatility in the equity markets, and that gives you a little bit of fodder when the market comes back down.
Bob Michael, do you like a 10-year at 3.55, 3.56?
Not in the least. If I look what the Fed's done so far, let's remember they've raised rates 225 basis points. We think they have more than that to go. They have at least another 250 basis points to go. So we're less than halfway through. The market's even pricing in another 225 basis points, so saying they're halfway there. I don't recall in what textbook it says it makes sense to fight the Fed.
What is fighting the Fed in credit then, right now, Bob? What about credit? Where does that leave things?
Well, credit, I have to say, is a point of a lot of debate internally. Our high yield team, bless their souls, looks at the high yield market yielding over 8.5%. They look at default rates hovering close to 0. They see default rates, in a recession going up to 3 or 4%, and feel that at a 500 basis point spread, you're compensated for that. And we're saying wait until we get into a recession. A reasonable spread level for recession is 750 basis points. We think at a minimum, the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
Victoria, would you agree with that? Wait, be patient here.
I think to an extent, you need to be patient, but I would say instead you need to be choosy in what you're doing. We're not investing in high yield. We don't think you should be taking that risk at this time because we do think if you're going to have earnings expectations pulled down, whether you go into a recession this year or next year, do you want to be in that high yield credit space? We look at investment grade credit, and I think you've got some better opportunities in those triple B names where spreads are out a little bit on the year, but not significantly. You're still not at the high spreads that you've seen in other crisis or other times like this. And so I think you have some opportunities there where you can build in, because the credit market is telling you, yes, yields are high, but I disagree. I don't think we're going to go double where we are right now. I think we're going to go maybe a little bit higher. Then when we hit slower growth, hit possible recessions, we're going to see yields come back down, and that's where you get the advantage of the yield curve along with a 4% coupon.
Just getting some breaking news as well, some headlines crossing a Bloomberg. Let's get to Abigail Doolittle on those lines. Hey, Abby.
Hey, John. Well, we do have breaking news, and we have breaking news on two major companies, starting off with J.P. Morgan. Jamie Dimon, the CEO of J.P. Morgan, in prepared comments, he has criticized higher capital requirements ahead of hearings. Of course, he and some of the other CEOs from big banks heading to Washington this week to testify on Capitol Hill in both the House and the Senate. This, of course, as the fall midterm election season heats up and a stack of proposed banking bills await potential action. They, of course, suspended the share buybacks back in July to quickly meet higher capital requirements tied to a harsher stress test result and previously flagged increase to its buffer to systemic importance. So again, Jamie Dimon is criticizing, blasting, in fact, those higher capital requirements ahead of earnings, ahead of those hearings. As for Microsoft, that's the other piece of breaking news that we have right now. They have raised their quarterly dividend 10% to 68 cents per share. The stock not really doing all that much, and I should say in J.P. Morgan, that stock not reacting to those headlines all that much. But given the fact that, John, as you know, that they did pre-announce, I think a couple of weeks ago, maybe it was a month and a half ago on Forex, this is probably a positive for investors, the fact that Microsoft is raising its dividend by 9.7% to 68 cents a share. Right now, that stock down about 0.5%.
Abby, thank you. About 24 minutes away from the open, about equity futures are lower by 6 or 0.7%. This market looked for another outsized rate hike from this Federal Reserve. Mike McKee joining us now for more. Hi, Mike.
Hey, John. Well, it's kind of interesting because the rate hike is probably going to be the least important aspect of the meeting since it's pretty much priced in already. What really is going to get people's attention is the summary of economic projections, what the Fed thinks is going to happen to the economy over the next couple of years. Right now, they've been looking at a 1% growth rate, 1.7% this year and next year, and then it goes up just a tiny bit, but all of those growth rates below what potential is. Look for that to change. Unemployment, look for that to go up. They're going to have to predict where they think unemployment is given where they think rates are going to be, and then look for the PCE headline to rise as well. Core, they're pretty much on target, but PCE headline is going to tell a lot to the markets about what they think is going to happen, which brings us to, of course, the dot plot. What do they think they're going to do about rates? The high white line there is what the market thinks the Fed should do. Expect the 2022 and 2023 dots to move higher, to match that with the median, but then do not look for it to come down the way the market thinks it's going to. The Fed's been very clear about higher for longer, and so then we get to Jay Powell's news conference where he's expected to repeat that remark by saying that they are purposefully moving their rates to a level that will be restrictive, sufficiently restrictive, and that will require maintaining a restrictive policy stance for some time. Powell expected to be on message and trying not to give anybody a reason to think that the Fed might pivot anytime soon. Now, as Bob Michael points out, the markets have priced in the Fed going as high as 4.5%, maybe a little bit higher at the moment, but they still think there will be a pivot in the latter half of 2023.
Mike McKee, thank you. Bob Michael loves to give you a question to ask in the news conference, so let's ask him that now. Bob, what would you like Mike to ask in this presser tomorrow?
I think he should push the chair on the balance sheet runoff on quantitative tightening. Every meeting, there's some debate about how high they're going to hike rates, and even the market's pricing in a doubling from here, which is dramatic change from the start of the year. Why are we stopped at $95 billion a month in balance sheet runoff? Why don't they put that live every meeting and perhaps ramp that up to $120 billion per month, which is the inverse of what they were expanding a couple of years ago. So I think there needs to be some questioning about their policy on balance sheet runoff.
Mike, your thoughts on that? Just to get your reaction to it, Mike. Why haven't we heard much on it?
Well, they're trying to make it something that runs in the background and doesn't influence monetary policy all that much. And what's interesting is that a lot of people in the markets are suggesting the Fed might be going too far too fast with balance sheet reduction, that there's a liquidity problem ginning up in the markets, and that they may have to stop sooner. So it would be interesting to see what he would say to your question, Bob, because it's kind of the opposite of the question he might be expecting.
Bob Michael and Victoria Fernandez are going to stick with us. Mike McKee, thank you, buddy, as always. Futures lower on the S&P 500 with your movers. Here's Abby.
Hey, John, well, let's reiterate that breaking news that we had relative to both JP Morgan and Microsoft. We have JP Morgan at this point down, just modestly down a little bit more than 0.5%. This, of course, after they did JP Morgan's Jamie Dimon, CEO of JP Morgan, said in prepared remarks criticizing the harsher capital requirements. This, of course, before heading down to Washington this week to testify before both the House and the Senate. Back in July, they temporarily suspended their buybacks to quickly meet stricter capital requirements. Microsoft down 0.6% despite raising their quarterly dividend by nearly 10%. That stock right now down about 0.6%, and they did raise it to about 68 cents per share. Ford is down sharply, down 5% on disappointing earnings. And then Norwegian Cruise Line up about 3.3%. This is, of course, on an upgrade, a more positive view there. So we have a little bit of the reopening flare helping out some of those cruise line operators, John, and the travel trade.
Abby, thank you. Coming up on this program, corporate America, feeling the inflation pinch.
The risks are certainly on the downside in terms of earnings expectations. They're still too high. It's really the margin story, I think, that has yet to weaken in any meaningful way. I think that will bring earnings down.
Ford, the latest company with a big warning. Their conversation up next.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to, quote-unquote, revitalize Japan.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. All eyes are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it. Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
The risks are certainly on on the downside in terms of earnings expectations. They're still too high. But having said that, I don't expect to see a very significant downturn in profits. Private sector balance sheets are actually quite healthy. We still have reasonably solid revenues because nominal GDP is actually quite strong. It's really the margin story, I think, that has yet to weaken in any meaningful way. I think that will bring earnings down.
Another warning from corporate America. This time it's Ford, bringing down its earnings estimates and writing in a statement the following. Inflation-related supplier costs during the third quarter will run about $1 billion higher than originally expected. A shortage of key components can disrupt Ford's production of vehicles. Kelly Lyons has more. Hey, Kelly.
Hey, John. Yeah, a big warning from Ford. They say that larger than expected $1 billion input on the cost side means that their adjusted EBIT's only going to be about $1.4 to $1.7 billion. That is less than half what it was a year ago and about half of the quarter reported last go around. And that is why we see the stock down about 5% in early hours. But we know, as you said, that Ford is not alone in issuing warnings of this kind recently. A number of big household names have done the same. FedEx, for example, issuing a profit warning late last week, citing a decline in global volumes due to the worsening macroeconomic trends. You had GE warning supply chain challenges will have a negative impact on profits. A similar story when it comes to the steel makers. That list goes on. The common theme is one kind of just stagflation, where growth is slowing, weighing on demand, and inflation is high, meaning higher input costs and pressure on margins. That's not a great recipe for corporate America and corporate profits, which is why we have seen earnings revisions for U.S. companies negative now for 15 weeks straight, meaning the downgrades are outnumbering the upgrades. But as you and I were talking about yesterday, as we were just hearing from Peter Oppenheimer at Goldman Sachs, that what we've heard from the likes of Mike Wilson at Morgan Stanley is that they still are too high, those earnings expectations. They expect more downward revisions to come, and they think the equity market will go down along with that, John.
Kelly Lyons, thank you. Victoria Fernandez, Bob Michael back with us. Victoria, first to you. The concerns around earnings, do you share them?
I do share them. And, you know, Jonathan, we talk frequently about kind of what our expectations are. And we actually thought we were going to see those downgrades come in the second quarter, and we didn't. So we pushed that back and said, okay, that's going to have to hit in the third quarter. As Kaylee showed, we've seen those continually come down, those expectations. But I think we also have to remember, you know, yes, there's concern on margins, but look where margins were in the second quarter. What do we have, 12% margins? That was down from a little over 13 in the first quarter. So margins can come down and still be solid enough for these companies to continue to do what they're doing, to continue with CapEx, to maintain their workforce, which is going to continue to be supportive for consumption, for consumers, for workers. So yes, I think we're seeing a slowdown. Yes, I expect the equity market to react to that, but I don't think we're going to fall off a cliff when it comes to earnings. And when you look at some of the notices that came out, Ford you mentioned, FedEx you mentioned, but at the same time, look at other companies. UPS came out and said, we don't have this issue. We still see strong demand. Last week at banking conferences, you heard some of these banks come out and say, look, demand is there, consumers are good. So we really have a mixed bag right now, and I think that's why we're going to continue to see volatility, but I think we do need to expect earnings expectations to come down for them to be lower than they were last quarter.
They don't see these issues yet. We've got mortgage rates, Bob, through 6%, maybe approaching 7%, had a massive repricing of real rates. How long before this shows up in the economic data, Bob, economic activity?
Well, I think that's what the Fed is looking for. They do see that they're raising the cost of funding, so it's impacting auto sales, housing, and credit card purchases, but it's coming down from a very high level. And as Victoria said, corporate profit margins are still pretty good. And they put in place 2 years of ultra low cost financing in 2020 and 2021. And you've got a tight labor market. So they've got to pass along that cost. I think the Fed's watching all of this, and I think it's going to cause them to have to go further than even we think in hiking rates to really lean in to this kind of growth.
Is that a 5 handle on Fed funds, Bob?
Well, for now, we're at 4 3/4 is a minimum. So yeah, 5's definitely in the realm of possibility. And one of the things that we've looked at is the Fed has never stopped a hiking cycle with both headline and core inflation above the Fed funds rate. So they've always gotten to a positive real rate.
So Bob, with that in mind, you've got the potential for 5% Fed funds. You've got a base case of a recession. Can you talk to me about
the character of that recession. I get a lot of guests on this program, Bob, you've heard them, who talk up short and shallow. If we get one, it will be short, it will be shallow. Do you share that?
No, I don't. I think that you have to step back and say the Fed is fighting a 40-year inflation problem, and they and the other central banks are horribly offside. So they're going to be very aggressive in here. On top of that, we've had 2 years of ultra excessive liquidity at a very low funding rate. So when you have tremendous liquidity, which is costless, it bubbles up and gets leveraged somewhere. And as you raise the cost of funding, certainly as the Fed is doing to that magnitude, something will go pop in the night. We're keeping our eyes out trying to figure out where that is. But for sure, something's been financed with too much liquidity at too low a cost, and that will pop.
Bob, that sounded like a subtle nod towards the potential of some kind of systemic problem. Is that a fair characterization of your concerns at the moment?
Oh, for sure, it's a concern. I mean, when you take this much liquidity out of the global system after it's been binged on and sloshed everywhere and inflated the price of everything for years, you've got to be careful about it. I'll tell you, at our investment quarterly, there was a divide, and it was very generational. There are those of us who were around in the early 80s who just see a lot of downside, and there's the more, let's call it modern school of thought, those have been around since the financial crisis, that believe MMT will cushion to the downside. We'll wait and see what the central banks think of that.
So, Bob, where do you think the risk is? Just as you look right now, where's the leverage? Because I'm told it's not on corporations or consumer household balance sheets. Is it on the sovereign? Where is it?
No. A lot of stuff got financed in credit. You know, there's a lot of discussion about what's going on in the loan market and a slower credit quality than previously. I think the private capital markets are very opaque. It's there somewhere. It may be in the public markets. But a 2.25% Fed funds rate and looking at the 10-year at 3.6% or wherever it is not leaning into any of that yet, which is why we're so pessimistic about where the Fed funds rate is going.
So, Bob, you get a lot of people who come to you and say, I need to put some money to work to find some income. Are you just pushing them to hold cash-like securities? Is that where you're pushing towards?
You know what, John? In the front end of the curve, we're looking at high-quality, short-dated cash flows. So we're looking in the securitized space, we're looking in the investment-grade credit space, and yeah, there are even some short-dated high-yield cash flows that look bulletproof to us. So we want to lend money to borrowers who have fortress balance sheets and just hide out there, collect somewhere between a 4.5% to 5% yield, and let this wave of inflation and central bank tightening wash over the market, and then see where prices are.
Victoria, I'm not sure if you've run away since Bob started talking, because it all sounds very, very bearish. Can I give you the final word on this?
Well, I'll try to bring a little bit of optimism here, but when we're talking to our clients, I mean, we do think there's areas that they can invest in right now. Obviously, we've talked about fixed income a little bit already this morning. Having that cash flow, that steady cash flow, knowing you have a stated maturity date to get your par value back, we think that's an option, and you can combine that with your equities. Look, we're looking at quality names, quality balance sheets, quality management companies, quality earnings. Combine that with some of the dividend components you have, and even the total cash return, right? Dividends and buybacks, then you can put yourself in a position where even with volatility in the market, even with all the things that we've talked about so far that are headwinds for the market, you still have a little bit of a tailwind to help buffer the volatility that you're going to see. So I think you can do that with your clients, and you'll be well positioned regardless of what the Fed and all the other central banks this week, because we know we're not on an island, right? We saw Sweden's central bank, 100 basis points, a lot more this week. You can be well prepared.
Victoria Fernandez, Bob Michael, to the both of you, thank you. Yields up, stateside, yields higher on bonds, yields much higher on gilts in the UK. The up and about just around the corner. Your morning calls up next.
consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Stocks are lower, down 0.8%. Here are your morning calls. First up, Truist upgrading Norwegian Cruise Lines to a buy, highlighting the company's strengthening booking trends. Barclays downgrading Nike to equal weight, warning that currency headwinds and China weakness could weigh on next week's earnings. And finally, Susquehanna downgrading PayPal to neutral, expecting margins to remain under pressure amid growing macro headwinds. That stock's negative 3%. Coming up, recession or no recession, Alpine's Sarah Hunt making the case for buying US energy stocks. That conversation up next. Equities down 0.8%.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
25 seconds away from the opening bell in New York. Good morning to you. Here's the price action. We head south, lower down, negative 0.8% on the S&P. On the Nasdaq, we're down 0.9%. On the Russell, down almost 1 full percentage point. Having a little look at session lows, and at the epicenter of this, it's in the bond market. That's the opening bell. Switch at the board and get to your bond market right now. Yields up 9 basis points. We're now looking at 360 on a 10-year, 358.27. Yields higher by 9 basis points in the US. Over in Germany, yields much higher by 14 basis points. Call it 13 right now on a German 10-year bond, with the gilt market, a 10-year up 17 basis points. This is global. The bond market getting shaken out. Yields absolutely flying. Euro-dollar negative 0.6%, 99.63. Got some dollar strength in the mix, and crude is lower by about $1 to $84.82. That's the cross-asset price action with your movers. Here's Abby.
John, well, we are looking at a bearish start, as you were just showing, and all 11 S&P 500 sectors at this point are lower. One of the worst, technology, really being weighed on by Microsoft. This despite the fact that the company just raised its quarterly dividend by almost 10% to 68 cents per share. But as you were just mentioning, yields, that is the story. That 10-year yield rising in an incredible way. And of course, the 2-year yield up for a 9th day in a row, the longest up streak since May of 2018, at its highest level since October of 2007. So, of course, those rising yields making everything else look much more expensive, especially high-growth tech. Ford down 5.5%, pre-announcing to the downside the third quarter EBIT on rising costs. They did maintain the full-year view, but investors not liking another pre-announcement. Royal Caribbean up 1.1% in sympathy with that upgrade at Truist for Norwegian Cruise Line on the better industry bookings. And then finally, John, Wynn Resorts up about 3%. This is Hong Kong signals it wants to end some of the COVID restrictions. China is perhaps going to agree to this, according to some reports. So we have these Macau casino operators higher. Wynn receives about 40% of its revenue from Macau.
Abby, thank you. About 1 minute and 40 seconds into this, we're negative 0.9% on the S&P. Energy down 0.5%. Materials down 1.4%. Every industry group on my screen right now trading in negative territory. Can I just spend a second or a few seconds going through the bond market worldwide? Treasuries, your 10-year, up 9 basis points, closing in on 360. The 2-year up 4, closing in on 4% at 397. Over to the gilt market in the UK. The 10-year yield up 16 or 17 basis points. The 2-year up by 18 or 19, going into the Bank of England rate decision later this week. The 10-year in Germany, in the bond market, yields up 13 basis points on a 10-year maturity. The front end on 2s up 12. Do you want a snapshot of where Japan last traded on a 10-year? 25 basis points. That's where the cap is. Yield curve control. The BOJ later this week. For how much longer can they keep things there, given what's happening elsewhere? Just a massive bond market shakeout right now that we'll stay on top of. So yields up, equities down by 0.9%. Apple is hiking its prices to combat the strengthening US dollar, writing in a statement the following: as early as October 5th, prices of apps and in-app purchases on the App Store will increase in all territories that use the euro currency, as well as those in 9 other countries. Ed Ludlow has more. Morning, Ed.
Yeah, morning, John. Apple down 0.3%, pairing some of its early decline at the market open, but a drag all the same on the S&P 500 and the Nasdaq 100. It's really important to look at the markets where these price hikes for the App Store and in-app purchases will take place, particularly when you think about the euro area and Japan. In Japan, for example, Apple will raise prices by 30%, 8% of its overseas sales. Important, though, given the yen weakness. What a story that's been in 2022, but also dollar strength broadly against key markets like Europe. If we were worried about this, and we've heard about it before, particularly in the context of the software names, about the impact of currency headwind, then how concerned are we going forward? Because you look across the S&P 500 by sector and the context of sales outside of the United States, this stronger dollar is going to continue being a story for the next 6 months.
Ed, thank you. Apple down about 1/3 early in the session, 3 or 4 minutes in. Ford, the latest with a warning following FedEx last week with the latest. Here's Kelly Lyons. Hey, Kelly.
Yeah, John, warning on inflation and that ultimately those costs are going to be about $1 billion higher than expected, which is taking shares of Ford down about 5% here at the opening bell and dragging down peers as well. The likes of GM, for example, down around 2 percentage points. Tesla a little bit more insulated. It's roughly flat on the day, but now Ford's loss is actually deepening. We're talking about 7%. It expects its adjusted EBIT to be in the range of about $1.4 to $1.7 billion when it reports results next month. So again, this is a pre-announcement. Compare that to what it reported last quarter and in the same period a year ago, in which both of those quarters, it earned $3 billion plus. So this is pretty light here for Ford in the third quarter. The good news, though, is if there is any, the full year sales outlook has indeed been held. But on the bad news side, the company also said because of shortages of key parts, its inventory of half-completed vehicles is going to stay elevated at what they guess is around 40 to 45,000 vehicles at the end of the third quarter. It said those largely are high-margin trucks and SUVs, so it's not those high-margin vehicles that you necessarily would want to see here. As for what that means overall, Ford's inventories of raw materials, it is sitting right around a record of $6 billion, John.
Kelly, thank you. That stock is not doing well at all in the last 24 hours. Kelly Lyons there on the latest. Your equity market, we're down 0.8% on the S&P 500. The battle line's drawn on Wall Street. On the one side, Goldman and Morgan Stanley painting a very gloomy picture of shrinking margins and a retest of June lows. On the other hand, Wells Fargo and JP Morgan making up a more constructive group, looking for near-term upside and resilient earnings. For more, it's Taylor Riggs. Hey, Taylor.
John, a lot of the technicals come from breaking through 3,900. We closed yesterday spot on 3,900. Of course, this morning a little bit below that. So that is when you think about an equity market year to date off about 18%. When you think about the probability of retesting those June lows, that is the setup for the S&P 500 as we head into all of the fundamental conversations as well. Let's start with the bullish side. Talked a lot about this. JP Morgan, earnings revisions may be bottoming. There's also been some low investor position. I've heard a lot about still a lot of cash on the sidelines waiting for that better entry point. The bottom of this, John, I know declining inflation views. Peak inflation has been sort of a huge bad call every sort of month this year, but nonetheless, that is sort of that bullish picture that represents the view of JP Morgan.
I put out a JP Morgan quote yesterday, you know, and just said, guess who?
Oh,
and,
no.
and everyone knew.
Everyone knew.
Everyone just replied Marco.
I know. Well, but so let's take the flip side of that, John. This is going to get a little sticky with the math. I'll try to be quick here. You think about sort of Mike Wilson at Morgan Stanley saying the equity risk premium, that's what we're showing here, way too low, with the 10-year yield that approaches 3.50, a 2-year that approaches 4. So you have to fix the front end of that equation in earnings yield. Either earnings go up or price goes down. I think the focus has been on the denominator of that earnings yield. That price has to go down to get that equity risk premium back up to fair value.
Super, super smart. Taylor, as always, looking forward to the close a little bit later. Thank you. Sarah Hunt of Alpine Woods laying out her calls into year end, right in the following. We have not given up on some of the larger tech names like Microsoft or Google. We continue to like energy and the US. A recession will hurt the energy call, but it will not be as negatively affected as the rest of the world. Sarah, I'm pleased to say, joins us right now. Sarah, let's start with that tech call. We just had Bob Michael at JP Morgan join us about 20 minutes ago, saying that in a minimum, this Fed gets to 475, and it may well have a 5 handle or higher. What does that mean for those tech calls?
Well, I think the biggest problem for technology is both the companies that don't have a lot of earnings, but also I think that we still think of technology in a basket that doesn't include staples. And I think that the argument that we've been making is that there are a lot of technology names that are really more like staples. And so you tend to see those stocks performing not so badly into slower economic news because people have to have their phones and they have to have their computers. So it's not quite the same as some of the more esoteric technology names where that's more of something that people want as opposed to something that people need.
Can we approach the valuation concern, though, with the 2-year yield closing in on 4%? Yield's up again today, and it's not just a local domestic US story, it's a global one. We're seeing big shifts in the UK, big shifts in the German bond market as well. Do yields need to stop going up to make this tech trade work, or do they need to go back down?
I think they need to stop going up, and I think the problem right now is that people don't know where that is yet, and I think that this is where we're looking for some commentary on what's going to happen this week. But in the end, I think that the June rally, that the expectation was that rates were not only going to stop going up, but they were going to start coming down next year. You know, Chairman Powell put the kibosh on that at Jackson Hole. So I think what you really need to see is some sort of stabilization and an understanding that yields have either flattened out or peaked is a hard word because there's been so much volatility, but I definitely think that you want to see things stop going up before that valuation becomes something that you can deal with better. I don't think that they have to come down.
I'm looking at a risk-free 4% in the bond market in treasuries. Sarah, what do the energy names offer me in comparison? What's the competition like now?
I think on the energy names, I'm not looking at it necessarily as a competition on the dividend yield, as I am looking at what's going on in the world. And part of the inflation that we're trying to contain with monetary policy is really a supply crunch. And that supply crunch is because we've had globally a lack of investment in energy. So I think that you've got some growth longer term there. And that's where, you have to look for growth in an environment where the rest of the world or the economies are slowing down. And I think on the energy side, you've got some possibilities, and you've also got the transition away from fossil fuels that is not going to be as fast as people think it is. So I think you've got some possibilities in those arenas, and I think that's one of the reasons that we like energy.
I was looking at some of the investment numbers, just the capex, $700 billion in 2014, $300 billion in 2021. That was oil and gas investments, and how they've declined. Amin Nasser of Saudi Aramco said the conflict in Ukraine has certainly intensified the effects of the energy crisis, but it's not the root cause. Sadly, even if the conflict stopped today, as we all wish, the crisis would not end. Sarah, is that what you're thinking about, these long-term dynamics beyond maybe a downturn in the economy?
Absolutely, because if you look at what's gone on with energy in the last decade, you've had this move to the idea that we were going to get rid of fossil fuels, and they started to be treated poorly, and so people did not want to invest in them. I think the problem is that that transition is a lot longer and more difficult than people think. I mean, if you look at California saying you need to have an EV but don't charge it because we have problems with the grid, I think there's a longer tail on that, and that lack of investment is really creating a supply problem. So even when you have fluctuating demand, the underlying need for the infrastructure that basically powers the entire world is still there.
Last time we spoke, you liked Devon, you liked Chevron. Are they still the two top picks?
We still like those on the E&P space. We also like things in the natural gas space. We like Chart Industries because they are a supplier into the LNG industry. I think LNG is going to continue to be important. I think that's part of your transition right there. But I think that you still have to look at this whole base and say, we are going to need a lot of these products for a longer period of time.
Sarah Hunt of Alpine. Sarah, always phenomenal. Thank you. Some big calls there on the energy front, on the tech front too, as those tech valuations confront a bond market that is really getting shaken out. Yields higher by almost 10 basis points, approaching 360 on a 10-year, approaching 4% on a 2-year, up 4 basis points to, let's round it up, 397, 398. That's America. Look at the gilt market. We're up by 19 basis points on a 2-year gilt yield to 328 on a 10-year, up by about 17. In the bond market, we're up by 13, 14 basis points on the session. Some big moves in the global bond market. We're going to be looking ahead to some bank testimony as well, with Jamie Dimon on deck in the next 24 hours or so. Shanali Basak has more. Hi, Shanali.
Hey, John, you're looking at a 14-page, single-spaced testimony that JP Morgan has released. Dimon will speak to lawmakers tomorrow as he meets the House. Bank CEOs will meet the Senate the next day. So what's on the agenda here? First of all, you have Jamie Dimon coming forth and saying that these stress tests and higher capital requirements on the back of them, the higher capital marks particularly, are bad for America. Remember, he has been beating this drum for a very long time. They had faced those harder stress tests, are going to be facing higher capital requirements because of those, as well as previously expected higher GSIB buffers. But, there's a different thing on the set of lawmakers' minds separately. That is higher mortgages that their communities are facing. That is higher rents. That is higher cost of housing in many areas. And remember, we have seen this before from lawmakers on Capitol Hill with Dimon and his peers that worry about pay for their communities, the bankers that work in those community banks, at a time when you're seeing many other banks, not necessarily JP Morgan, but many other banks step back in terms of hiring and workforce. We saw JP Morgan most recently announce that they would also be cutting some of their workforce when it comes to their home lending business. But there are a lot of concerns on the minds of lawmakers today as these bank CEOs meet Washington. Remember, these are not the investment banks, but they are the biggest lenders to the communities in America.
Shanali, where have you been? It's been too long. Good to catch up.
Little vacation, John. I'm back in time to hit the hill, I guess.
You're allowed to get a rest, that's for sure. Shanali Basak, thank you. Coming up on this program, Russia moving to annex the regions of Ukraine it controls.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins.
That conversation still ahead.
difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in it, just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, they're half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
For a young person who might like to have a career like yours, what would you recommend?
I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position.
Sometimes I'm being asked whether there is enough of weapons that we have received, and I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
The Kremlin moving to annex occupied parts of Ukraine, staging sham votes as soon as this weekend. Russia's Security Council deputy head saying, quote, annexation would be irreversible and enable Russia to use all possible force and self-defense in the newly acquired territory. Team coverage starts right now with Bloomberg's AMH here in New York, Maria Tadeo in Brussels. Anne-Marie, the latest, please.
Well, what you could see right now is obviously this really undermines what is going on in Russia, and Putin really feeling like he has to give some sort of success, but make no questions about it. This would escalate the conflict. When I spoke to Dmytro Kuleba yesterday, he had said that Luhansk is the only region right now that has full Russian control, but the Ukraine still wants to continue in trying to make up some of the gains that Russia was making. Take a listen.
The next phase will be to continue liberating our territories. We will continue our counteroffensive in the east of the country. I would like to recall that since 24th of February, the only region that Russia controls in full is this Lugansk region of Ukraine. Now, we have a clear goal of depriving Russia of this control, which will send a clear message that since 24th of February, Russia literally achieved no strategic gains in Ukraine.
John, if Luhansk is the only region, an area that they have control over, Putin might feel like this is his one moment, recognize these territories similar to what he did in Crimea, bring them into the fold of Russia. Then they would become, in Russia's mind, in the Kremlin's mind, legal Russian territory. That means he would say to his people he has legal base case to use nuclear weapons there, potentially chemical weapons there, and also send Russian conscription soldiers there, not some of these others that they are hiring.
Maria, what's the reaction on the continent?
Well, Jonathan, we're still waiting for official reaction to this, but I can tell you some officials that I spoke with, of course, repeat the line that this is a fake referendum that the Russian Federation is now doing in retaliation, of course, for the loss and the pushback that they suffered in Kharkiv. This is an act of escalation, also of desperation from the Russian Federation to try to score a win, but also repeat potentially, if this goes ahead, that it will not be recognized. This will not be recognized as part of the Russian Federation, and the people involved in this will be once again subject to sanctions. I think you also need to listen to the Ukrainian side here, which they say, well, the threat from Russia is not diminishing, it's going in crescendo. That proves the point that we need more weapons. I want to again remind everyone that for the Ukrainians, every part of the territory of this country belongs to Ukraine. They go back to 1991, and they say that is exactly what victory looks like. They will not accept this.
Maria, some people would see this as an escalatory step this morning. Other people might suggest that this is a Russian leader trying to bring this to a close and redefine success. Which one is it?
Look, in his mind, this may be a way to put an end to this, but he does know very well that he has been warned by the European Union, by the United States, that this has to be solved diplomatically, that for the Ukrainians, this is a red line. The Ukrainians will say this is something that we're going to fight, and we're going to fight on the battlefield. They will increase their calls now for weapons in the country. And also going back to the point that Anne-Marie mentioned, you do see a country that potentially is now shifting from a special operation. Remember, Vladimir Putin always said, these are professional soldiers. We're slow because we don't want to hurt civilians. The story on the ground is very different to now potentially going into a full war. And you always have to factor this, Jonathan. When you declare full war, the social impact and the pushback that it could have could be enormous. This is a wild card for Vladimir Putin. There can be many men in Russia who say, I just don't want to go to the front and fight. I'm not a soldier. I don't want to go.
Two of the absolute best. We're lucky to have you both. Thank you. AMH in New York City, Maria Tadeo in Brussels. Anne-Marie will be tremendously busy over the next couple of days with the President heading to New York and the UN General Assembly. Equities are down 1.23% on the S&P. We're 21 minutes into this mess. The Nasdaq is down by 1 percentage point. Yields are higher on Treasuries by 9 basis points to 358. Mentioned it a few times already this hour. It's not just Treasuries. It's Germany, it's gilts, it's pretty much everything. In the UK, the 10 years up by 16 basis points to 329. In Germany, we are now higher by 14 basis points to 194. That's the bond market, that's the equity market. Let's dig into that stock market with some sector price action. Here's Abby.
Hey, John. Well, with this bearish action, as you were just mentioning, the S&P 500 down more than 1%, having everything to do with yields being higher, that 2% yield knocking on the 4% door, up a 9th day in a row, the highest since 2007. All 11 sectors are lower and by about 1% or more. The worst sector, materials, all 28 stocks are down within that sector. This even as the commodity index is basically flat. Real estate also down about 2%. Those dividends looking less attractive as yields push higher. Consumer staples, on the other hand, that's another dividend-rich sector, but it's actually the outperforming one, down just 0.8%. And tech, interestingly enough, also outperforming. So it's sort of an interesting shift here. Over the last few weeks, though, John, as yields have simply marched higher, it has really hurt tech the most. You can see that New York FANG index, the mega cap index, that also includes a lot of China tech, it's down about 3% over the last 3 weeks. Banks at one point had been higher. They are now down ever so slightly, however.
Abby, thank you. Stocks down, yields up, dollar stronger, euro dollar 99.73. That currency pair negative 0.5%. Sterling trading weaker going into the Bank of England the day after. That decision will come the day after the Federal Reserve. Cable 113.93. Sterling down about 1/3%. Coming up, the trading diary just around the corner.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
A rough, tough start to Tuesday. Equities down 1% on the S&P. On the Nasdaq, we're down about 0.8%. Yields absolutely flying on treasuries, on bonds, on gilts. A 10-year gilt up 16 basis points to 330 on a 10-year in the UK. Yields higher, stocks lower. Here's your trading diary. We begin with the president speaking at 1:45 Eastern, then heading to New York to deliver his speech at the UN General Assembly. Plus existing home sales and big bank CEOs testifying on Capitol Hill. And it's the main event, a Fed rate decision and Chairman Powell news conference, followed by rate decisions from the BOJ and the BOE on Thursday. And we close out a week with US PMIs on Friday. Looking forward to the Fed coverage with you. We'll kick that off in a big way tomorrow morning. Live from New York. This was the countdown to the open. This is Bloomberg.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. he emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody.